9 a.m. here in New York City on this Monday, December 9th. Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Shauna Smith alongside Brad Smith, and let's get you the three things that you need to know today.
Good morning, everyone. First up, U.S. stock futures trading in the red this morning as shares of Nvidia weigh on the broader market following a report that China has opened a probe into the company on suspicions that the chip maker has broken anti-monopoly laws. The State Administration for Market Regulation opened an investigation into the company on its 2020 deal from Mellanox Technologies, as well as recent behavior. Nvidia hasn't commented on the probe as of this morning.
Plus, investors awaiting the latest read on inflation this week for any clues on what it means for the Fed's path forward. Traders aren't fully pricing a quarter-point cut from the Fed when it meets next week, adding to uncertainty looking into 2025. But Wall Street strategists do remain bullish on the stock market. The S&P 500 will gain 17% through the end of next year thanks to a strong economy. That's the latest call out from John Stolfus of Oppenheimer. He set a target for the S&P year-end of 2025 of 7,100, making him the most optimistic among strategists on the street that we track.
And President-elect Donald Trump gave an interview to NBC's Meet the Press this weekend where he said that he has no plans to replace Fed Chair Jerome Powell once he returns to the White House. Powell told reporters last month that he wouldn't step aside early if Trump asked for his resignation. Trump had previously said that he should have a say in monetary policy and the setting of interest rates. It's not permitted, though, under federal law right now to fire a Fed chair, which Powell addressed at his last press conference. U.S. stock futures moving lower as Nvidia weighing on the broader market this morning. There's a probe in China. But in other news, the S&P 500 getting a new street high target of 7,100 by Oppenheimer, indicating a 17% gain through the end of next year. Here to break down the call and to discuss what's on the agenda for the week is our own Josh Schaefer. So let's focus in on the targets. We'll put Nvidia on the back burner.
We'll go broad first.
Yeah, right? Let's go broad first here. So what's really playing into this new price target?
Yeah, I mean, I think what we're seeing from John Stoltzfus at Oppenheimer is really not dissimilar to most of these calls we've been talking about, right? Which is essentially, you're looking at a scenario right now where it feels like the U.S. has continued to head for a soft landing from an economic standpoint. Earnings are expected to grow next year. Where Stoltzfus's call gets a little bit different is sort of the math that works for these targets, right, guys? So if you look at his projected earnings at 275 earnings per share for the S&P 500, not really different than what a lot of people are arguing. But when you look at what his potential PE is, he sees the market trading at about a 25.8 forward 12-month multiple. That's about 3 points higher than what it is right now. It's around 22, 23. So essentially what he's saying there is, yes, earnings are going to grow, but also perhaps there's a little bit of just this risk-on vibe in the market right now that continues into next year. And you see you see earnings pushing up stocks, yes, but you also just see price continuing to move up. He also calls for a little bit of that broadening of that rally, right? He notes that given the success we've seen in the AI trade, to also have the broadening of the rally gives you more support and a little bit more confidence in what's going on here. And he also highlighted, Sean, I'll point out, that he thinks AI will benefit all 11 sectors in some way, which is a little bit of a different call than what you hear from people, right? He's not just talking about tech. He's saying at some point you're going to start to see productivity gains across the S&P 500 from AI. I think the question would be whether you actually see that in 2025 or maybe a little bit later.
Yeah, whether or not it's a longer-term story. Yeah, you're exactly right. And that's what really stuck out to me. And also just the fact that he was talking about how much more efficient AI is going to make the economy, how it's then going to help further support the U.S. economy going forward, which we have certainly seen obviously just be so resilient here over the last several quarters and several years, to say the least. But Josh, just tying what we're hearing from Stolfus to what we could hear this week, when we talk about the economy, the two key inflation prints that we're going to be getting out later this week, how the Fed is exactly going to, I guess, fold that into their calculus just in terms of rate cutting cycle and what that ultimately means for next year. Where is the thinking on that?
Yeah, I mean, it seems like most of these strategists are sort of comfortable with the narrative that's already playing out, but we haven't necessarily heard from the Fed, right? So what you would expect this week, I think, from consensus would be another sticky inflation print. That's what it looks like right now based on projections. You get another sticky inflation print. The Fed probably moves down its expected cuts for next year, right? So that SEP, the Summary of Economic Projections that we had in September, said probably 4 Fed rate cuts over the next year. people probably think that comes down to 2 or 3. That's kind of baked into some of these forecasts, which I think is important to remember this week. Might give us a little short-term volatility, but overall, the sticky inflation story seems to be something that people are sort of pricing in at this point. It's an expectation that inflation is not instantly falling. The Fed is not going to be issuing nearly as many cuts as we thought 3 months ago. But the key part of that being, and strategists come on our air and say it all the time, if the economy is still doing well, while the Fed isn't cutting, then there is a case for equities to keep moving higher, right? If we're still in a good position. And I think when you look at last week's jobs report, you see a little bit of that Goldilocks aspect to it, right? Yes, unemployment rate ticked up a little bit. Maybe that's your case for a cut or a case for them to keep lowering. But the US economy bounced back from a job adding perspective, right? You still have wages growing, which could be an issue for inflation, but it's also good for your consumer. And so it seems like right now, to sort of sum all of that up, yes, Wednesday into next Wednesday, so this inflation print into next Wednesday are really the only 2 planned events that people are watching at this point. They give a little bit of a risk to this rally, but it doesn't seem like too many people are arguing that it's going to take down the rally at this point.
All right, Josh, great stuff. Thanks so much. Let's continue the conversation, what we could expect from the CPI print later on this week and what ultimately it means for the Fed and the broader market rally. We want to bring in Katie Kaminsky, Alpha Simplex Chief Research Strategist and Portfolio Manager. Katie, it's great to have you back here on Yahoo Finance. Let's piggyback up off what Josh Schaefer was just telling us here. So here we stand today. You have the S&P coming off its 56th, the record closing high of the year. Lots of momentum into year end. Is there a risk, or how real is that risk, that what we hear over the next week or so could potentially halt some of that momentum?
I'd have to say that the risk seems to be low right now, at least for what we're seeing. I mean, we're seeing things very calm. I think that there'd have to be extreme shifts in the data to such a degree that there would be sort of a risk of slowing that rally down. I think, as you said before, there's not a lot of data that is going to come out, and it seems to be the general consensus that even if we have some upside on inflation data, that's still not going to change the narrative too much. So I think in that sense, it's really sort of still looking pretty good going into year end.
Okay, and so if there is kind of this drift higher that we can kind of bank on here, what does that mean for momentum going into 2025 and where we might see even a continuation or a repositioning of the thought process for some of the most favorable sectors that have already run so far and so fast, and now investors are going to be really weighing what the incoming administration is putting on the table, and then additionally just weighing the broadening out that we've been waiting for even further from here?
Well, this is a good question because momentum signals have been continually increasing across equity sectors and across equity indices, particularly in the US versus non-US trade. So we've really seen sort of really resilient and steady equity signals. But the one thing we have been watching to some degree is this relative difference between small cap and tech and large cap. And what you have seen last week was a little bit more narrow. So I think people should actually pay attention to that because even though last week was a positive week, there was a lot of divergence and only a few sectors such as tech and consumer were up. So I think it's really about sort of if we see more broadening towards the end of the year and we see that into next year, then maybe momentum will be less vulnerable to a reversal or overcrowding.
Katie, how much of the fear of missing out, the trade that we've been talking about that has kind of carried some of that momentum here that we certainly have seen in the market, how big of a factor do you see that being at this stage?
I think it's a huge factor because if you look at how the markets reacted post-election, clearly a lot of people are not wanting to miss out on this particular trade. And if most indications still seem very positive, you have a lot of people that may still want to sort of continue if they think this rally will keep on going. And so I think that will definitely have an ability to continue to create more momentum in the equity markets, which has seemingly been the case since the US election.
And so as we're kind of looking forward into next year and trying to think about what the earnings growth profile that we should be expecting in combination with what companies are going to be talking about with the broader macro data that, of course, we're getting just a little bit more of before the end of the year and before the Fed's next meeting. How does that kind of square up against where you're positioned right now going into the start of the year?
Yes, I mean, really the interesting point for us is we follow multi-asset class themes. And the one theme that has been persistent has been strong US versus non-US. It's been strong big tech versus non. And it's also been strong US dollar. And so I think that is something that is going to be important, this U.S. pro-growth theme that we've seen. And I think that has to come to fruition. So when you talk about earnings, we need to see numbers that are consistent with that theme so that it comes to fruition, that we don't really it isn't just a momentum trade.
Katie, how much of the trade going into 2025 is going to be carried on the back of AI? We just had Josh talking about the fact that AI really playing a critical factor, I guess you could say, into John Solfis's latest view or note that he had out calling for the S&P next year to reach 7,100. Is that a driving factor? And I guess what are we going to see just in terms of that leadership? To what degree?
Yes, and I agree with that AI is a big factor because it is a big part of expectations for investors about how AI is going to shift the narrative for many different companies. I think what makes me pause a little bit is the amount of time that takes. So I think that makes sense on a longer horizon, but it's going to take more research and understanding to understand how AI is going to infiltrate other sectors more directly. I think the narrative in tech is clear, but we're going to need to take some time to actually see that play out in the year to actually understand its impact on other sectors.
Katie, thanks so much for taking the time here this morning ahead of the opening bell. Appreciate it.
Thank you.
Well, shares of Nvidia sinking in pre-market after Chinese officials announced an antitrust probe into the U.S. chip maker. Joining us now, let's bring in Dan Newman, who is the Futurum Group CEO. Dan, you see a headline like this come across, got to wonder what goes through your mind, especially as this goes directly at the poster child of the AI trade.
Yeah, Brad, good morning. First of all, nobody should be surprised to hear about an ongoing set of probes against Nvidia, especially coming from China. Now, there's sort of two sides to this one. There's the first, which is the more ongoing microaggressions that exist between Chinese and US firms. And of course, as China continues to struggle to keep up with the most leading edge advanced AI chips, they probably want to do what they can to slow US firms down. On the other side, China's talking about a 4-year-old commitment that came from Nvidia to make sure that Mellanox, which is the networking technology that they've bought that's really enabled Nvidia to continue to create differentiation in these systems that they're building, and saying, hey, is Nvidia helping enough with Chinese-made chips and using this networking technology to advance what China is doing? And of course, that's a challenge too, because China is so far behind right now due to a combination of controls, a lack of the materials and technologies to build the most modern AI chips. So I think what we have here is really more of a macro geopolitical strain than a real probe. But NVIDIA is so successful that they're going to get probed by every regulator in the world over the next few years.
Do you see it, Dan, I guess, having a significant impact just on the roadmap there in China, what that future strategy looks like? And you talk about the fact that this is a really a geopolitical headline. I guess then my follow-up would be, how big of a risk maybe does this, or how big of a risk signal is this to some of the other larger chip players who do still have exposure to China?
Every company is right now looking at the calculus of their business in China. We see companies like Qualcomm, Intel, AMD, all have double-digit percentage market share in China. And of course, they want to continue to sell into China. We also know that President-elect Donald Trump is planning to put some pretty strict tariffs into place. Now, of course, I always put a balance there because President-elect Trump does not want to harm the markets in any ways. I think a lot of his campaign was on creating a strong stock market economy. And of course, these firms like NVIDIA are such a big weight on the indexes. He doesn't want to see them get harmed. But at the same time, we don't want to continue to feed China with the best and most advanced technology. And that comes from many of our companies, not just NVIDIA. That comes from our cloud computing leaders like Microsoft and Google. That, of course, comes from our OEMs, the Dells and of course, the Lenovo's and other companies here that are really large selling systems, HPEs. And so they really have to think about how they manage that relationship. But I think as a whole, every company has to worry because China is such a large consumer of products and, of course, technology leadership from the U.S.
In any tit-for-tat kind of scenario that we see play out, it's typically the companies that have the largest revenue exposure to China that we see have a bit of a pullback here as investors start to recalculate what the interim period at least holds. Based on what we've seen before, and then what we've also seen before in exemptions, what type of exemptions are you anticipating, and what even quantifiable pullback could be on the table if we were to see this play out in a broader kind of tit for tat that impacts some of the largest U.S. companies that have the most revenue exposure to China?
Yeah, I mean, we've already seen a little bit of this play out in the real world. We've seen Micron get significant challenge from China. That impacted revenue substantially. And before that sort of big high bandwidth memory pivot that happened over the last year with AI, it really harmed Micron. And then, of course, we recently heard some probes into Intel and the business that's going on with Intel. And of course, we know Intel has been in a delicate position. So NVIDIA is a little bit of a different play. And there's been this ongoing sort of moving target of creating these scaled back AI chips that could work in the China market. But recently we heard, anything below 7 nanometer, they were going to cut off through these new export controls. That's basically every chip that's been designed recently for that market. And so you're talking a multi-billion-dollar impact, double-digit % revenue for NVIDIA, not as high as some companies. Others like Qualcomm have even higher exposure, but we expect this to continue to play out. There just is no circumstance until, over the next few years that China and the US aren't going to continue to strain, because AI is not just about this technology. It's really about global economic and defense leadership. And the US doesn't want to weaken its position.
Dan, when you take a look at the reaction that we're seeing in pre-market here today, you've got shares off just about 2%. That move to the downside, is that a bit of an overreaction, or is it something that maybe does make sense given some of those longer term concerns?
I expect a series of ongoing probes that will take place. I think this will hit the news cycles every quarter or two, with a different part of the world probing NVIDIA. I think some investors may get a little bit spooked when these things happen. China, of course, is such a large market, but we also have to let this play out, because like I said, I mean, the growth of NVIDIA, they can barely fulfill all the demand outside of China right now. The growth is so incredible, but this is also a company that's run up to around a $3.5 trillion market cap. So there's also going to be breathing periods. And I think investors may look for moments and signals to maybe sell, take some profits, and then possibly re-enter if there's a meaningful pullback. But I think it's just the beginning for NVIDIA and this entire AI trend, which I heard your guest before talking about the exact same thing.
And just quickly, 30 seconds here. We got Oracle reporting earnings later on. And of course, the larger question is, what is the common denominator that you're expecting to see and continue to hear among software names that are trying to communicate their AI pitch to investors and to customers right now?
Yeah, two or three quick things on Oracle. One, their cloud infrastructure growth has been really incredible. They've been really bullish on building out this AI trend line. Two, their software is highly embedded into these enterprises they work for. So I love that they have so much predictable revenue. And so what I would look for as an investor is basically, is this technology sticky, and are companies going to continue to build their enterprises on Oracle? I think it's too sticky to move on from, with over 75% of their revenue being predictable. I really like it, and I expect to see a good result, but look for that OCI and that cloud number growth to continue to be faster than the other clouds, because it is a little smaller, but it's grown really, really quickly.
All right, Dan, great insight. Thanks so much. Coming up on Morning Brief, we will count you down to the opening bell on Wall Street. Plus, we'll have more on Nvidia as China probes the company. And Macy's getting a renewed activist push, according to reports. We'll discuss that and much more coming up on Morning Brief. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of this session. It's all done with Yahoo Finance's trending tickers page. First up, let's take a look at Apollo Global Management and Workday, set to join the S&P 500 later this month as part of the index's quarterly rebalancing. Two companies will replace Qorvo and Amentum holdings. The changes are set to take effect prior to the start of trading on December 23rd. We do want to note Apollo Global Management is the parent company of Yahoo. But let's talk about exactly what this means and why this is significant. So when you talk about the fact that a company is being added to the S&P 500, the reason for the significance, obviously it elevates the brand, the awareness surrounding companies that are part of the S&P 500. But we talk about investors wanting to gain more broader exposure to the market right now. And as we have seen that, we've seen the rise here in popularity of some of those passive investing funds. And I think that really gets to the criticality and the importance here of the S&P 500 inclusion here, the fact that we are seeing growing popularity of the passive investment funds. So you could then draw a correlation to the fact that it could lead to outperformance down the road. On the flip side, when you talk about the companies that they are replacing here this time around, I mentioned Qorvo and Amentum. Those are getting replaced. It's pretty much the opposite reaction, you would think, or the flip side, getting the boot can potentially weigh on your stock price going forward. But again, Apollo and Workday set to join the S&P. That's going to happen right before Christmas, before the start of trading on December 23rd.
Yeah, spot on. Not much to add to this. I mean, at the end of the day, it's pretty straightforward. Also, but you hit the main point here, and one other addendum to that is the fact that now it increases and the reason that you're seeing these two companies that are being added in Apollo and Workday in replacing Qorvo and Amentum, Apollo and Workday are moving higher because this also means that they're going to be a part of more portfolios just as a byproduct of being in the S&P 500. And so now it makes it even more of a higher profile company for both of them and the exposure that they're going to have within those, because investors, when they're thinking about, okay, where are the early, interesting and passive ways, to your point, to invest, it really is looking at some of either the major indices or ETFs that also track up against those major industries. And that's exactly what we're seeing here play out this morning. Great job. Also, finally, Omnicom. They're set to acquire Interpublic in an all-stock deal that's creating the world's largest advertising company. The deal is expected to close in the second half of next year. Taking a look at the move here on the day, of course, you're seeing Omnicom, move lower by about 3.9%. Interpublic moving higher by about 12.5% here. This is pretty standard operation for exactly what takes place between an acquirer and the firm that's being acquired. And so ultimately, it seems like together the companies feel like they're going to be strongly positioned for continued growth in a new era of marketing that they're talking about here. And also under the detail of this, the Omnicom team will now have over 100,000 expert practitioners, they say. And this is, I think this is key, especially given the digital transitions that so many companies are trying to have top of mind right now, either within precision marketing or CRM, within their data and advertising. All of these things considered, both of these groups kind of put together a stronger positioning to go out to their portfolio clients with and perhaps build up an even broader base.
Yeah, it could certainly put them in a stronger position here. I also think it speaks to the broader trend that we are seeing, more aggressively speaking, within this sector, and maybe the pressure that this industry is under. When you take a look at some of those larger tech names, when you take a look at Alphabet's parent company, Google's parent company Alphabet, when you take a look at Meta, when you take a look at generative AI, there has been some concern that is going to replace some of this work here from creative ad agencies, and that was exactly the point that MoffettNathanson took here over the weekend. They were quoted saying that this really shows the pressure that the industry at large is under. They need to cut costs, they need to reduce capacity. They're doing that through M&A here, at least, or in terms of consolidation here, to better position themselves against some of those larger tech players. They also went on to say that, quote, it feels like we are on the precipice of significant secular changes. So you talk about some of the pressure that we have seen more broadly speaking. Interpublic shares have been struggling. They're down about 10% since the start of the year. Omnicom is up at just about 20% since the start of the year. So we are seeing that movement here this morning that Brad was just explaining, very, very typical in a deal like this. But I think when you just take a step back and take more of a macro view of what this signals here for the industry, it does signal the fact that this industry will likely remain under a bit of pressure here, given the fact and given the rapid adoption of generative AI, and maybe that putting into question just the role and importance of some of these creative ad agencies?
You know, I'm just looking at this bottom line that all of our viewers are seeing here on their screen, and this deal expecting to be closed by the second half of 2025. Here's why that is also significant. We've heard from companies and executives in recent weeks following the election that they're anticipating more of a deregulated environment. This could be the first inclinations that we're seeing, not only for companies to really position themselves for survival and continued operation within their industry in the face of AI, but also looking towards potential opportunities to consolidate where those deals have been harder to get through regulatory commissions to this point because there has been so much more of a stringent look at what this would mean for the consumer. I think more broadly, though, this is more of that business-to-business relationship, more of the likelihood that it would get through. Also, the combined revenue that we would see from this company, their transaction is expected to generate $750 million in those annual cost synergies that you were mentioning as well, and be accretive to the adjusted earnings per share for both Omnicom and Interpublic shareholders as well here. So that just a little bit more of the broader context here as we've been watching the stock move here this morning.
All right, we'll keep right here on Yahoo Finance. Coming up, we've got the opening bell on Wall Street. Stay tuned. You're watching Morning Brief.
There you're taking a live look at the opening bell at the Nasdaq, where you've got PTC. You down with PTC? Yeah, you know me today. I'm just learning of them. Anyway, great folks up there ringing the opening bell. They got some funfetti. And on the left side of your screen, you got the live shot from the New York Stock Exchange, where Ashland is ringing the opening bell. Ticker symbol ash. Very appropriate. Let's take a look at the opening bell here as we're seeing the major averages as of right now flat just barely to the upside, for the Dow Jones Industrial Average. We've seen some hyper waffling coming in to the start of today's trading activity for the Dow, but the opening cross sees us in the green. The S&P 500, you're seeing that's to the downside to begin today's trading activity, lower by about 0.1%. We'll get over to the Nasdaq Composite in a hot second. Taking a look at the S&P 500 since we're on that thread, though, we've got a live look at the 11 S&P 500 sectors pulled up on the screen for you. It's technology actually pulling up the caboose here to start off the trading session, down by about 0.5%. But let's take a look at XLE Energy. It's up by about 1.1%. All right, let's go back to the Nasdaq here. Taking a look at the tech-heavy average here, and this is the Nasdaq 100. We couldn't fit all 3,000 on here. It would have been a blitz for you. But all in the same, we're taking a look at Nvidia here. Of course, this on a probe from anti-monopoly practices from China, and that's moving lower here by about 3% here as we've been continuing to track that this morning. One of the top trending tickers on the Yahoo Finance platform. And for more on the opening cross here and the early trade, let's get to Yahoo Finance's Jared Blickery for a look at what's moving. Hey, Jared.
Hey, Brad. Well, I wanted to go to the Russell 2000 just to highlight real quickly. Had been leading in the pre-market, and it's leading in the early going today. It is very close to its record highs, but hasn't been able to do it just yet. Not sure what happened there. Let's dial down to a two-month chart, and there you go. So pretty close, and traders awaiting that breakout level, but we just haven't seen it today. We got a lot to get to, so let's just visit the sector action. I was looking at tech. So we got cyclical sectors leading, but tech is a laggard today. Tech was a big leader last week, but we're not seeing that today. I did want to focus on ARC Innovation because you take a look at, aside from Tesla kind of warps this sometimes. ARC is split today, but ARC is actually at the highest level since about April of 2022. It has really come back since its depressed price action following the pandemic. And then we got to get to China. China has seen the biggest jump today. Let's see, we got that the surging the most since October of last year. So we got Alibaba, that's up 7%, Pinduoduo up 8%, JD.com up 9%. We saw Chinese stocks kind of race out of the gate a few months ago, and they weren't able to continue that. That was based on expected stimulus measures. We haven't quite seen all of those take effect, but there's some more inklings that we might get some of those today, and so that's the excitement over there. And I want to get to the futures action because we have, and I'll start with crude oil. Crude oil is jumping. We had that big OPEC Plus decision last week, and we can see it's up 1.5% today, and that kind of set the tone, but there are some demand issues, and that's being felt today. Saudi Arabia has lowered its prices for certain Asian buyers, and we see that kind of happen around some of these decisions. Even though we're not seeing a negative price action today, we are seeing a little bit of a bullish actually jump. I think that's kind of a hangover from the weekend or just some other effects. Something I would think about. There's not a lot of demand in oil land right now. But we are seeing silver jump. Now, silver is jumping by the most in 7 weeks. And here's a 3-month chart. You can see these relatively recent highs over here. So we're kind of in the midsection here. And this is either where you would expect short traders to assert themselves, or you jump over this line here and you're racing towards those highs. So we'll see what comes of that. Did I mention copper is jumping as well? That is up 2% today. And we can see those relative highs back in late September, early October. And then to round things out, I got to get to crypto land because Bitcoin has just been oscillating around the 100,000 level. You can see a lot of red back there, but Ethereum is where my eyes are this morning as it approaches its 2024 highs. Let me just show you a year-to-date chart, and you can see, there we go. We got these highs from earlier in the year that it is testing right now, but still needs to go a little bit further to get to those ultimate highs around 4,500. But nevertheless, I think people will be putting on their Ethereum 4,500 hats pretty soon here if we get some more momentum to the upside. Guys?
We'll say, all right, Jared, thanks so much. It's time now for today's strategy session. The S&P 500 on track for its best year since 2019 as the index continues to clinch record high after record high. But the market's biggest driver, the Mag 7, is showing some signs of pullback from its rapid growth. Joining us now, we want to bring in Jake Manukian. He is at JP Morgan's Private Bank U.S. Head of Investment Strategy. Jake, let's start right there with the role of Mag 7. As we look ahead to 2025, what's your assessment just in terms of how investors should be thinking about how critical it is for the market's continued rally?
Yeah, I would say it's Important but not critical, right? I mean, these companies they're the largest shares in the index. Index concentration is at all-time highs. But the good news for investors is that their profiles are very attractive, right? They have the widest cash flow margins in the market. They have the lowest amount of levels of debt, and they have secular drivers of revenue and earnings potential. So I think they're obviously important for the market, but they're not critical for the market's success. And we see signs that earnings growth is set to broaden out as we head into 2025. And I think after the election, a lot of people are willing to kind of look ahead. That psychological overhang is in the past, and they're looking for more opportunities in all different segments of the market.
Even with regard to the concentration that you were mentioning, how and where are the sectors or even names that are perhaps most primed to take on some of that share of concentration?
Yeah, I mean, the public markets aside, I think what's really interesting is happening in private markets, right? You guys were talking about deal making and some of the merger and acquisition activity that's happened. You know, Wall Street's been in this kind of ice age for the last 2 years in terms of deal activity. When you think about IPO issuance, high yield issuance, lev loan issuance, we've seen a collapse in activity given interest rate hikes, given fears of recession, given elevated inflation, and we've seen a nascent recovery, but I think given a shift in the regulatory environment, that's really going to change. So when you think about private equity exits, private equity deal flow, when you think about the opportunity that private managers have, I think it's compelling to us.
It sounds like opportunities across capital structure.
Yeah, across the capital structure too. I mean, if you think about all of the the debt financing and the mezzanine level financing that it takes to get these deals done, we expect more volume and more opportunity there. And when we think about that from a portfolio construction angle, we're very optimistic. There's a lot of ways for investors to get those kind of like high single digit, low double digit returns. Yeah. From a lot of places, whether it's large cap equities or whether it's private markets, whether it's mezzanine debt, whether it's direct lending, whether it's infrastructure, whether it's real estate. There's a lot of different levers that investors can pull to build a resilient portfolio that can still generate attractive returns.
So the way that I'm kind of thinking about it now is it sounds like it's who's financing the deals, which leans towards financials and the larger banks.
Yes.
And then on the other side, it could be small and mid caps that are most primed to be acquired, but you'd have to be really judicious
selective
about where you're picking those.
Exactly. I mean, a better deal-making environment should support multiples and valuations for the small and mid-cap spaces. But yes, the financial sector, the asset management industry broadly, those are two places in the public markets that should benefit.
Talk to us just about how you're thinking about Fed policy and how big of a factor that is into some of these opportunities.
It's a factor, but I think investors have to understand that the Fed isn't the primary catalyst in the market anymore. They're in easing mode. There's going to be a debate about how frequently they cut or how many times they cut, but their policy stance is set towards easing. We're not seeing any signs of inflation from the labor market, and that's really what they're trying to support. And as long as that shift has happened, and it's happening globally, you saw the news from China over the weekend is that they're in that kind of supportive easing mode as well. That's happening in the background. That's the undercurrent, but that's not the big catalyst, we don't think.
And so if the Fed is not the big catalyst, is the catalyst 1600 Pennsylvania Avenue?
Yeah, well, I think that's what investors are thinking right now, right? The shift in the regulatory environment is something that we're well aware of. What we feel there's a lot of policy mix that I think investors are going to have to debate, whether that's the tariff side, whether it's the kind of labor force consequences of changing immigration policy. But there's a clear sense that this will be a friendlier administration to Wall Street and to deal-making activity, and that's where we're anchored from a perspective of where we want to add risk in portfolios.
You go back kind of to where we started talking about the fact that we are seeing this broadening here just in terms of earnings participation, where we are seeing that growth. We're expected, maybe it's a better way to say that growth going forward. What are the top, I guess, where do you see that leadership coming outside of maybe some of those tech names? Who do you see leading in 2025?
Yeah, I mean, one of the sectors that we're focused on is industrials. I think there's a lot of both cyclical and secular catalysts for the industrial sector, and one of them is the kind of geopolitical environment and then this broader idea of security that encompasses a lot of different factors, whether that's supply chains, energy resource, access to energy resources, whether it's infrastructure. A lot of that investment, and globally, this isn't just a U.S. story, will benefit members of the industrial sector.
Jake, thanks so much for taking the time in studio this morning.
Thank you guys very much.
Absolutely.
Appreciate it.
Time now for our chart of the day. Let's send it on over to Catalyst co-host Madison Mills for a look at profit growth. Hey, Maddie.
Hey, Brad. So if we take a look at profit growth estimates for 2025, you might be throwing a little bit of cold water on all of those aggressive price targets that we are getting in for next year, and that is because profit growth for the Magnificent Seven is expected to slow down just a bit here. The projected profit growth for this year alone is at 34% for the Mag 7. Next year, it's expected to drop down to 18%. That would put healthcare, which has been a big laggard year to date this year, as the top reigning king of the S&P 500 in terms of profit growth next year. Also, for that Mag 7, if you strip out 6 of those names, we're expecting only 3% growth in profit for next year, according to Bloomberg Intelligence estimates. So, does this mean the Mag 7's reign is coming to an end? Well, not necessarily, because I want to point out some stats from last year. Analysts were expecting growth of 19% for the Mag 7. As I said earlier, it's now projected to come in at 34% for this year. So the street has underestimated big tech previously. Also, we've got Nvidia in the room, and we are not expecting a slowdown in Nvidia more broadly moving forward into 2025. Obviously, today was standing with that geopolitical news out of China. I do want to note, though, that we are already starting to see this rotation playing out. In the week through December 4th, we've already seen the biggest outflows in 6 weeks for the Mag 7. Small caps, meantime, getting $4.6 billion in inflows in that same time period. So that could be end of year rebalancing, but it could also be a sign that the street is getting ahead of this decline in profit growth, or I should say slowdown in profit growth that we are anticipating for 2025 here.
All right, Maddie, great stuff. Thanks. TikTok's future in the U.S. hangs in the balance after an appeals court upheld a sale or ban law for the social media app. In the latest episode of Opening Bid, Yahoo Finance executive editor Brian Sozzi sat down with Project Liberty founder Frank McCourt, who has advanced a bid to buy the social media site's U.S. arm. Here's a part of their conversation.
We don't know what ByteDance is going to do. You know, they may let it shut down. I hope not. President-elect Trump hopes not. And President-elect Trump is a deal maker. I'm a deal maker. I think that there's a deal to be made here so that the U.S. TikTok can stay in business. We want to see the platform stay in business and the 170 million people enjoy it. It's a very popular platform. We don't want to see it shut down or banned. And as I said, President-elect Trump has said he doesn't want to see that either. So let's see if we can find a way here to make this a win-win-win where the U.S. TikTok is split off from ByteDance. China gets compensated for that. U.S. citizens are no longer have their data scraped and have information, quote unquote, spread to them, which may or may not be accurate, and Americans can be protected, and the U.S. government can fulfill its duty to protect American citizens.
You can find new episodes of Opening Bid every Monday, Wednesday, and Friday morning, 8:30 a.m. Eastern, across all podcast platforms. Coming up, Macy is facing a proposal from an activist investor. We're discussing with an analyst who calls the stock very undervalued. That's next.
Macy's is set to report its delayed earnings this week and update its full-year guidance. The postponed results come as activist investor Barrington Capital has taken a stake in the retailer, calling on Macy's to reduce CapEx, repurchase up to $3 billion in stock, also look for alternatives for its luxury operations, and they're advocating for Macy's to create a separate unit for its real estate holdings. In response, Macy's saying that it remains confident in the current, quote, bold new chapter strategy. Joining us now, we want to bring in David Swartz. He's Morningstar's retail analyst. David, it's great to have you back on Yahoo Finance to discuss this. We're seeing some movement in shares of Macy's here this morning, moving to the upside. I'm curious just to get your quick reaction, your first take on what we're hearing from Barrington Capital.
Surprised. Macy's has faced activist pressure in the past, and with the extremely low valuation, I was really expecting that activists would step up at some point again. And Barrington has been involved in activist campaigns against retailers in the past, so it made a lot of sense that an activist would get interested in Macy's. However, it's unclear if really Barrington has much of a plan here that Macy's isn't already doing. Because if you look through the presentation, a lot of the things that Macy's is doing seem to align with what Barrington wants. So I'm not exactly sure what they're going for here, except maybe to get some board seats and maybe some influence over the company.
Do you think it's likely that they'll be successful?
Well, I think that we could see some agreement. Last year, Barrington was involved in an activist campaign with Hanes, which I also cover, and that really kind of ended without a big splash. There was an addition of 3 board members, and Barrington agreed to be essentially a consultant to Hanes Brands. And similar to Macy's, Hanes was already doing a lot of things that Barrington wanted them to do. So I think we could see a similar situation here. There's no indication that Barrington is going to launch a hostile takeover or anything like that. As far as I can tell, Barrington is still a very small shareholder of Macy's. So it's likely that we'll get some sort of agreement, I think, between the parties in terms of maybe a consulting agreement and board members.
David, you mentioned the fact that Macy's evaluation is very low. The push then from Barrington for stock buybacks, it sounds like that's a strategy that actually might make sense to you.
Yeah, it does. My fair value estimate on Macy's is $25 a share. So right now I actually have Macy's as quite undervalued. And I do think that Macy's perhaps should step up stock buybacks. Some of the other things that Barrington is pushing for, like improving the margins, would not be so easy. But, but stock buybacks would be one way potentially of improving the valuation in the short term.
And so all these things in mind, Macy's out with their statement as well this morning and their strategy. Is that strategy measuring up against what investors have expected to this point from your analysis?
Yeah, I think so. Macy's has agreed to close some underperforming stores, which Barrington appreciates. They're also investing in the stores that are working better. And I think that's something that investors generally support. We haven't seen it really in the stock price at all. Clearly, the stock has not been going anywhere. Remember, there was a potential takeover of Macy's just a few months ago, which didn't go anywhere. It fell through in July. Since then, the stock has not really performed at all, because I think people are really not believing that Macy's is committed to any major transformation in the company that would increase value.
Hey, David, our colleague Brooke DePalma had a chance to speak with Macy's CEO Tony Spring just about a month ago, asked him about the activism pressure, how Macy's has responded, where they stand right now in the talks. I would love to get your reaction to what we heard, but here's what he had to tell Brooke at the time.
The board unanimously voted in favor of parting ways from the discussions and focusing on the strategy of the company. You're going to have those things happen. And again, our strategy was not a 1 month or a 1 quarter strategy. Our strategy is a 3-year strategy, and it's creating sustainable, profitable growth.
David, what do you think of Macy's strategy at this point? When you talk about the turnaround efforts, you talk about how long it's going to take. Is that something that investors should be confident in?
No, not really, because realistically, this is the 3rd major turnaround plan that Macy's has had in just the last decade, and the last 2 did not generate a lot of value for shareholders. So people are understandably skeptical that this new plan is going to make much difference either. One big change that Macy's has done is that they have agreed to close stores that may actually be profitable today, but are probably not going to be profitable in 5 or 10 years. So that is a bit of a bolder move than what we've seen in the past. But realistically, store closures in the past have not improved Macy's same-store sales growth or other metrics. So people are understandably really waiting to see if anything works here.
David, thanks so much for taking the time here with us today. I certainly do appreciate it, talking all things Macy's.
Thanks.
Coming up, everyone, we're taking a look at some of Wall Street's top analyst calls this morning when Morning Brief returns. We're taking a closer look at some trending tickers moving on the back of analyst calls. First up, Bank of America seeing more upside for Tesla, raising its price target to $400 from $350. This comes after the analyst John Murphy visited the company's Gigafactory in Austin. Murphy writing that the trip increased his confidence that Tesla is well positioned to grow next year, particularly with new vehicles and the launch of its robo-taxis and longer-term optimism from Optimist Investments there. The analyst also saying that there's more opportunity for margin improvement there. I love a good robot story.
Always.
optimist.
So does the street. It's up just about 3%.
Yeah.
All right, plus Reddit getting an upgrade at Morgan Stanley to overweight from equal weight. The analyst there nearly tripling its price target on the stock to $200 a share. That's up from $70 a share, and that's a street high. Brian Nowak writing that they have been wrong. They have been wrong on the sidelines with Reddit this year, but he doesn't think that they've missed the boat completely. That's why they have a price target of just about $200, so just about $28 higher or above where it is currently trading. He does, though, note that its focus on user engagement, also advertising, could help bolster further growth. Looking ahead, he sees user and time spent per user growing, also sees ad pricing rising, and an upside to ad load.
And finally, eBay initiated at Wedbush with a neutral rating and a $70 price target. That $70 is among the highest calls on Wall Street. Analyst Scott Devitt writing that he sees few near-term catalysts to drive upside to estimates or material inflection in growth, but he also says that there's minimal downside risk to near-term numbers as well here. And there you're taking a look at eBay shares really trying to get their minds around what ultimately is going to take place here for the toss-up that could be this earnings call.
It's anyone's guess, I guess, at this point.
Yeah.
All right, well, that does it for our morning brief, but keep it right here. We've got Catalyst coming up next. Welcome to Catalyst. I'm Shauna Smith alongside Madison Mills. We are 30 minutes into the U.S. trading day. Let's get to the three catalysts that we're watching this hour.
First up, we'll break down what November's CPI report will mean for the Fed's path forward and discuss the state of Fed independence.
Plus, we'll take a look at the latest Goldman Sachs conviction list and the stocks that the firm sees best positioned to outperform.
And we'll break down the national security concerns at play for TikTok as the deadline for the company's forced divestiture from its parent company ByteDance still looms. President-elect Donald Trump says he does not plan to remove Fed Chair Jay Powell before his term ends in May of 2026. Here with more, we've got Yahoo Finance Fed correspondent Jennifer Schomburger. Jennifer, great to speak with you. Tell us what we learned from this critical interview last night.
Good morning, Maddie. Great to see you as well. Happy Monday. That's right. President-elect Donald Trump said Sunday on Meet the Press that he does not anticipate removing Fed Chair Jay Powell from his term before it expires in May 2026. When asked if he plans to cut short the central bank chief's tenure, Trump replied, quote, "No, I don't think so. I don't see it." The comment comes after both the president-elect and Fed Chair Powell seem to be striking a more conciliatory tone towards each other than previously. Last week, Powell said that he hoped for a good relationship with the new Trump White House and Trump's nominee for Treasury Secretary Scott Bessent, who once suggested in an interview that Trump could appoint a shadow chair to undermine Powell's influence. All of this after Trump on the campaign trail regularly weighed in with criticisms of Powell, offering that the president should, quote, have a say in Fed decisions and that Powell has, quote, gotten it wrong a lot. When Fed Chair Powell was asked just after the election whether he would step down from the central bank if President-elect Trump asked him to leave, Powell said simply no. When pressed by reporters on what legal authority Trump has to fire him or any other member of the Federal Reserve Board, Powell simply replied, quote, not permitted under the law. Back to you.
All right, thanks so much, Jen. Well, the Fed has one last meeting before President-elect Donald Trump takes office, and markets are currently pricing in an 87% chance of a 25 basis point rate cut ahead of two key inflation prints that are coming out later this week. I want to bring in Jennifer Lee, a senior economist and managing director at BMO Capital Markets. And Jennifer, it's great to have you back here on Yahoo Finance. Let's talk about what exactly is at stake here with these two inflation prints. I guess how critical are they in how the Fed is thinking about how much progress we have seen in terms of the fight to tame inflation, what ultimately it will signal about the path forward?
So good morning, and thank you very much for having me on. You know, the data are always important, but I got to say these days it's almost like less important, especially on the inflation front. I mean, we know that, inflation has been coming down. We're no longer at, 9% or whatever it was a couple of years ago. And the Fed chair said a few weeks ago that, that he believes that inflation is heading sustainably back down to that 2% target. I think what's probably more interesting at this point is what's going to happen next year, and with the planned tariffs that are going to be kicking in. Who knows? Maybe on day one of the new presidency. So that I think is going to be more worrisome, I think, for the Federal Reserve. So, I think a 25 basis point cut in a couple of weeks is almost like baked in, unless it's something outrageously weird happening in the November CPI numbers and the PPI numbers. I think it's more, it's more important to see what they're going to say, what the communication is going to be after they make their announcement at the next meeting.
So it sounds like you are not anticipating us getting any kind of whispers from the Fed through a Nick Timrose article at the Wall Street Journal heading into that December 18th meeting.
It seems like we always do somehow get a little bit of a whisper, but again, actually it'd be very interesting to see what he says. But assuming that, inflation is up modestly, on a month-to-month basis, we see roughly the year-over-year heading a little bit higher, still a bit too hot for the Fed's comfort. We might see some stickiness still in housing, in the services sector in particular. That's going to prompt, probably just again a 25 beat rate cut. But we are going to see what they say, what the communication is, what their forward guidance is going to be. And I think they're going to be highly, highly data dependent. And there's going to be a lot, that's going to be happening in the first couple of months of next year that will help determine which direction. Actually, we're assuming that they're going to continue cutting, just more like the cadence or the pace at which they're cutting will be determined, I think, with whatever happens in the new year.
Jennifer, what is your assessment just of where things stand? Obviously, we talk so much about inflation, but when you take a look at the jobs market, especially on the heels of the print that we got just last week, is there anything that is still concerning to you? Or when you take a look at the print last week, aside from the unemployment rate ticking up just a bit, it really shows the fact that the labor market does remain resilient and on strong footing?
It is. I'm very interested in the wage front in particular. We saw it's still decent, a little bit higher than expected, average hourly earnings pace. We saw that in the latest personal income and spending numbers, up about 0.4, 0.5%, which is what the average we've been seeing over the past year. And that's good news for consumers. It shows that, besides the fact that the labor market is still pretty healthy, we've got decent job growth, we've got decent wage growth, and that underpins a stronger consumer going forward. But of course, it all depends on how much prices are going to be rising, whether or not inflation is going to be really flaring higher or not in the coming year, and that will also help determine consumer spending. But as long as they have something put aside for a rainy day, as long as they tuck a little bit aside for their in their savings, I think the consumer will be well placed to deal with higher prices, or at least slightly higher prices.
Well, one reason they may be well placed is because we're continuing to see wages growing up. Morgan Stanley this morning noting that aggregate payroll incomes are rising at a 5.5% annual rate, and that's continued to accelerate every single month over the past few months. When does that wage growth start to stoke more demand and therefore reignite inflation?
So we could potentially see some pulling forward of spending. If consumers are, again, with some decent savings, behind them, if they are anticipating higher prices in the coming months, you could see some pickup in consumer spending, and that could flare potentially more inflation, and that would be something that will not be welcomed by the Fed. So this is something we would have to certainly keep an eye on. But I think it's not just like a spending on a month-to-month basis. Again, it's how much they're putting aside, which is, I think, more very important. Again, just to show that they are well placed to deal with anything that comes their way, or almost anything that comes their way. As long as there's some savings put aside, I think it leaves the consumer in good shape.
Building on the Trump policies and what we could see play out here over the next several months, next 4 years, how should investors just be thinking about that, just in terms of the economic side of things, what ultimately it's going to mean for economic growth?
I'm going to have to say to expect the unexpected. Uncertainty is going to be one of those certain things to play out, and you just have to be very cautious. And again, depending on how the tariffs play out, whether or not we are going to actually see, that 10, 20% blanket tariff on everything that's coming into the U.S. If it indeed will be 60 or 70% on imports coming from China, that could push prices higher. Of course, all of it will depend on what U.S. businesses are going to do with those higher prices. Are they going to eat it, or are they going to pass it along to the end consumer? And most likely they're going to, pass it along to their customers. And that will be playing out in the higher inflation front. So we have to be very cautious to see how that plays out. And of course, what retaliatory measures are coming back as well from the U.S., whether or not their trading partners will sort of take it, or they will say, we are going to tariff your things as well. So a lot of things, a lot of balls up in the air, and so much uncertainty. So I think you have to be very cautious heading into the new year.
All right, Jennifer Lee, thanks so much.
Thank you.
Let's take a look at some of today's market headlines to start the hour, sponsored by Tasty Trade. 30 minutes into the trading day, let's take a look at the major averages, some of the movement that we are seeing. Still a bit of a mixed picture. You got the S&P just below the flat line, coming off another record-setting high, but you do have the Nasdaq and the Dow holding on to just some slight gains here in early action. Flipping over to the bond market and taking a look at yields, we are seeing yields pushing to the upside once again. You got the 10-year yield up just about 3 basis points, still below that 4.2 level. And flipping over to Bitcoin, lots of focus on Bitcoin as it did surpass 100,000. We still see it though trading just below that milestone mark there, just above 99,000. Again, a trade to continue to watch. Well, coming up, we're taking a look at some of today's top trending tickers. We'll give you the news behind those moves. That's next on Catalysts. Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session. All done with Yahoo Finance's trending tickers page. First up, BYD on track to beat its 2024 sales goals after recording its fastest growing month this year. The Chinese EV maker now expected to sell more than 4 million cars this year. That would overtake Ford and Honda. So let's unpack the latest numbers that we are getting here. For the month of November, the company sold just over 506,000 units, bringing the total during the first 11 months of the year to 3.76 million. And Maddie, as we take a step back, the reason why this is significant is we talk a lot about the domestic Chinese market and some of the traction, a lot of traction that these companies, that these domestic players are certainly gaining there inside mainland China. How big of a threat, how big of a challenge it has been to some of the U.S. traditional automakers. And now you're seeing it play out just in terms of on a global scale. When you stack up these numbers, just ultimately what that means maybe about the direction of this competitive nature going forward. And I do think it puts into question, and it has certainly put into question when you take a look at the headlines over the last several months, just in terms of what exactly the role of some of these U.S. automakers, how big of a role, how little really of a role they are going to play within that market, it sounds like at least, or seems like at least, going forward.
Yeah, because they've already beat out Tesla in terms of EV sales. They're set here to outsell Ford and Honda moving forward. I wonder how the Chinese stimulus is going to impact this as well. If we do start to see a stronger consumer ticking up in China, if that could lead to even more upside for BYD. Or is it really just company fundamentals here? Is it part of their growing capacity that they've been putting money towards on the balance sheet, the massive hiring spree that they have had, and their ability to keep up with additional product lines? That is something that we've seen other EV makers in the space struggling with. So perhaps there's a little bit of a playbook from BYD for those other automakers as well here. All right, next up, let's take a look at Palantir teaming up with defense tech company Anduril to advance the use of AI in the U.S. military. Battlefield information will be collected by Anduril software and then pulled into a secure Palantir platform that will then use the data for AI training and development here. I think what's really key here and interesting to me is that this comes just one day after Anduril announced a partnership with OpenAI aimed at developing and deploying advanced AI for national security missions. So this is really a broader approach from Anduril to embrace AI. That's something that Anduril CEO spoke with our own Josh Lipton about at our Invest conference. And it's part of this growing trend that we've seen pushing Palantir to record highs. This morning, the stock briefly hitting a record high on this news.
Yeah, you can certainly see the excitement play out on the street just in terms of what ultimately this could mean here for growth down the line. You got the stock up just about 2.5%, but it does bring us back to what we heard the Anduril's CEO tell Josh Lipton just about a month ago. And he talked about a lot in the context of the incoming Trump administration, what exactly that is going to do for the sector at large, some of the opportunities that could be outlined from policies, even though we are certainly seeing, or there is still certainly much uncertainty surrounding what exactly is going to get implemented. But very much when you talk about the partnership, some of the growth opportunities there, and you see this this partnership here with Palantir, clearly it could benefit, and I think it does benefit. It's ultimately beneficial here for both sides. All right, let's take a look at Burlington. It was actually added to Goldman Sachs' U.S. conviction list. Analysts saying that the company is ideally positioned for today's economy. Meanwhile, Amgen and Global E Online were removed from Goldman's conviction list. We want to talk about that and more with Steve Crone. He is Goldman Sachs' Director of America's Equity Research. Steve, it's great to have you on. Lots of stocks that we want to get into here, but Burlington really caught our eye just because we talk so much about the consumer, the state of consumer right now, value hunting. I'm curious from Goldman's perspective, why is Burlington so much better positioned than some of the other players within the space?
Yeah, so thanks for having me. It's nice to be back with you guys. As you point out, in this report that we published last week on the update to our conviction list, we did highlight the consumer. We've had a view, and we continue to have this view, that the consumer is well positioned into 2025 from a spending standpoint. It's the linchpin of our macroeconomist, Jan Hatzius's global U.S. GDP forecast, where he looked for 2.5% GDP growth. Consumer makes up 2/3 of the economy, and that's above consensus. Behind that is the consumer being financially sound. You think about easing inflation. You think about strong household balance sheets. Consumers in a really good spot, very good employment data. Consumers in a really good spot to spend. So you think about the off-price retailers. They're in that sweet spot of consumers that are seeking value right now. Also, higher income consumers that are looking to trade down for good brands. And Burlington's been executing really well. So our analyst, Brooke Roach, that covers the stock, has been very positive on this story. She's above consensus on expectations going forward. And they also have some cost discipline in place, so you should see margin expansion there.
I want to flip over to a company that got dropped, and that's Amgen. Can you talk to me about the base case for that?
Yeah, so look, Salveen Richter covers the stock. She's still very positive on Amgen. As we talked about last time we were here, this is a list of 20 to 25 of our top ideas coming out of the research department. We keep this list relatively fluid over time. So there's no change in Salveen Richter's view on Amgen going forward. She's still buy rated on the stock. We just found other opportunities for this list at this time.
And one of the big things that you did highlight here, or just take into account, is the role of the Mag 7 and big tech, especially on the heels of some of the work done by David Kostin. Nvidia is still on that list. When you take a look at Nvidia's role in terms of the broader market, really setting the tone here for the AI trade, what is Goldman's expectation there?
Yeah, so Toshiya Hari covers the stock, still very positive on this. We spoke, the three of us. I talked about how do you really differentiate on a name like Nvidia, right? This is an ideas-driven list where you're presumably finding the best idiosyncratic bottoms-up fundamental ideas. And it's all earnings-driven, right? He has been well above consensus on his earnings expectations and remains well above consensus on his earnings expectations for Nvidia. But your question is broader. You referenced Kostin's work about the market into next year, still looking for nice growth from the Mag 7, but that earnings growth to be less than the delta between the rest of the 493, if you will, to be less than that of what it was in 2024, the current year. So to a degree of maybe 7% outperformance versus 30%ish. And I saw your segment earlier about the broadening out of the market and the earnings expectations coming from others. Our list, and over the last couple of months, we've added 4 mid-cap names to this list. So we're seeing opportunities elsewhere. Last month, we added Meritage Homes, a really nice home builder that's seeing margins improve. And we've added other mid-cap names over the course of the last couple of months because we see that same broadening out taking place.
But in that segment earlier, I talked about how Nvidia is still the superstar of the Mag 7, that the Mag 6 are kind of the ones that are falling off to the sidelines. Is part of Toshiya's view that Nvidia just still has the growth story moving forward, even if it is slowing with profit growth?
It does. Look, we've been in this infrastructure build-out stage, right, of the AI revolution. And certainly there's a lot of demand there. The question that investors are starting to ask, and we're starting to ask, is how does that transition to the application phase? How do companies start to drive revenues from artificial intelligence as opposed to building out the infrastructure and maybe it being more of an efficiency vehicle? And that's the types of questions people are asking. You've seen some early signs coming through in names like Snowflake and names like Salesforce this past quarter, where they're starting to see a little bit of that. But that is the question in the marketplace right now.
Steve, what I love about this note here is it's not only that you're talking about what names have worked, what names you expect to work, but you also dig down into what has changed and also what has not worked. And I'm curious about that last part there, just in terms of what do you think is the biggest investor lesson when you take a look at how the conviction list has performed, what has not worked in the past? Maybe what does that tell us about the setup heading into the new year?
Yeah, look, we try to drive this bottoms up, fundamental driven, sourced by our analysts, selected by a committee in our internal review committee. We are very focused on the earnings revisions, right? The best way to generate alpha is when you are, your work supports differentiated views on the earnings, on the numbers, and the stock should follow. And so the lesson is we're not perfect, right? We get things wrong. And in our report every month, we hold ourselves accountable to 4 relative metrics. We hold ourselves accountable to the number of stocks since inception that have outperformed the market equal weight, because we treat this as every stock equal weighted, versus their own individual GIC sector and versus our broader coverage in the Americas, which is 1,200 stocks. And our performance has been in around 55 to 60% on 3 out of those 4 metrics, market being the one where we're in the lower 50s, and that's driven by the Mag 7, which outperformed the market considerably. And right now we have 1 name on the list.
Outside of the Mag 7, though, you can still play AI. And Toshiya has a stock in here. I'm fascinated by this pick of Teradyne. I know you are not Toshiya, but since we have you here, can you talk to me about the inclusion of a name like this and what it tells us either about this company specifically or just more broadly about finding those other ways to play the AI rally outside of those expensive stocks?
We have a couple of names on the list that are playing that AI rally. I mentioned Snowflake earlier as well, and they're a software company that is really strong on data and taking structured and unstructured data and helping companies incorporate that, and that's going to play into the AI transition to revenues. But Teradyne is a system-on-chip testing company. And it's not just AI, it's traditional chips that are powering computers and devices as well. And that's more to Toshiya's call on just semiconductors overall. He's been positive on segments, and he thinks that there's more need for testing, quite frankly. And certainly it lends itself as AI continues to grow, there's going to be more need for a business like Teradyne.
So looking at those chips plays beyond just the AI plays. Steve, always great to have you. Thank you so much for coming on to talk the conviction list for 2025. We appreciate it. Well, more tickers that we are watching today, Mondelez and Hershey. Mondelez reportedly exploring an acquisition of the chocolate maker, creating a company with a combined sales of nearly $50 billion. If we can pull these stocks up full screen here, I can tell you what we're seeing in the moves. Mondelez moving to the downside off the news, down about 3%. Hershey's moving strongly to the upside, up nearly 15%. It was initially halted off the back of this news, but then it started trading again just about 10 minutes ago, right before we came back for our second segment here. This is according to people familiar with the matter who spoke with Bloomberg News originally. Mondelez has made a preliminary approach about a possible combination with Hershey's moving forward here. This is also not the first time that Mondelez has sought a deal with Hershey. They also sought a deal back in 2016, but then walked away after they were not able to reach an agreement on price. So it'll be interesting to see if we continue to hear news of these additional mergers. This isn't the only M&A news that we're getting on this Merger Monday here. If this is a bid ahead of the incoming administration to increase some of these deal making here.
You talk about the size of this deal, the value of this specifically, roughly $46 billion. That's according to data that was compiled here by Bloomberg. And just to put that in perspective, if this deal were to happen, it would actually then top the value of the year's biggest deal when we saw Mars's agreement here to buy Kellanova for nearly $36 billion. So again, when you talk about the size of what the deal would be in today's dollars, we certainly are seeing some excitement play out from the street here with Hershey. You mentioned the move to the upside at the highs of the session, at least so far. It had been up just about 19%. That was the biggest intraday move that we have seen in just about 8 years for Hershey. Now it's up just about nearly 15%. But again, any deal is going to require the backing of Hershey Trust, giving it roughly 80% of the voting power of that company. And that trust has been slowly selling Hershey shares in an effort to diversify the holdings, and reporting that's being done right now. But again, any deal would require the backing of Hershey Trust. And Maddie, like you said, this is something that Mondelez has sought in the past. They tried to do it back in 2016. The offer was rejected by Hershey. So we, of course, will see how this plays out.
Absolutely. And we've seen some pressure on the packaged food industry as a whole, too. So that could also be something that regulators consider on this particular deal. All right, coming up, we are addressing pressures on the health insurance industry with Oscar Health's CEO. That's coming up next right here on Catalysts.
Following the assassination of United Healthcare CEO Brian Thompson, other insurance companies, including Humana, Blue Cross Blue Shield, have removed executive bio pages from their websites, while CVS and Cigna have removed images of their top executives. Joining us now for more on the state of the healthcare industry and the insurance industry, we want to bring in Mark Bertolini. He's Oscar Health's CEO and former Aetna CEO, as well as our healthcare reporter, Yahoo Finance's Anjali Khemlani. Mark, it's great to have you. Thank you so much for making the time to join us. We want to start with the tragic event that played out last week. In terms of how you are looking at this as the CEO of Oscar, some of the discussions I'm sure that you've been having with others within your industries, what steps are you taking to help mitigate some of the risk, particularly in terms of the executive security right now within the industry and specifically at Oscar?
Well, I think we always have building protection anyway. At work, we think our employees are going to be safe. I think it's really moving around and being in the public that raises some concerns at the executive level. I think in this case, largely the CEO level. We take all sorts of precautions that we have been doing for a long time. I've been used to it for a long time in my career. And so while this act in itself was unconscionable, the behavior of the American public in reaction to it is understandable given how frustrated people are with the state of our healthcare system in the United States.
Yeah, Mark, Anjali here. Great to have you on. I know that, when we were initially planning to talk 2 weeks ago, the conversation was going to be entirely different, which was about the incoming Trump administration, which we will get to. But I'd love to get a little bit more of your thought process on right now. You said it yourself, the reaction from the public isn't surprising. We've heard from security agencies talking about a rise in violence in the health sector, largely in the facilities themselves, especially in the last year and a half. What does that tell you about what you need to expect and how you're thinking about the company and where it needs to go in order to help reduce this tension that is clearly being felt by the American public?
Well, the American public exists in a system that was designed 80 years ago after World War II. And it was designed in a way that we built a lot of hospitals across the country. And we also provided benefits free through employers as a way of making wage control work after the return of soldiers from World War II. And I think that system is largely now broken, and it has been broken for some time. I've been an advocate for change for a long time and believe that we have ways to get it better in this country. And I think it largely starts with making sure our health system meets the needs of individuals, not the needs of groups. And right now our system in large part is built around meeting the needs of groups.
Mark, I want to talk about some of the change that we have seen in response to the online response here. Blue Cross Blue Shield, as you know, rolling back a change to their anesthesia policy that would require additional payment from consumers if the anesthetic did have to last longer than it was presumed to last ahead of the surgery here. Do you anticipate more changes like that to come off the back of this online reaction?
Yeah, I think at Oscar, we've actually designed an HMO product that is frictionless for members. They don't get in the middle of pre-certification or authorizations. We do that with the doctor, and we do that digitally as ways of moving that of fog of behavior out of the consumer's view and focusing really on the very few things that we actually reject every year. And things that we know are subject to abuse, instead of authorizing and requiring referrals on everything. And I think that takes some of the noise out of the system, because people aren't sort of slogging through, okay, what do I got to do next to get my care? We want people to feel that they have good access to care. And so removing some of these barriers are going to be incredibly important.
Mark, what does the timeline look like for that? And in terms of some of those longer term effects or the impact that is going to have, longer term impact that is going to have on the sector, how receptive is the industry at large to maybe some of these changes?
Well, I think the industry's in a different, all the players in the industry are in different places based on their lines of business and the way they run their operation. At our company, we're largely in the individual market. And what we know is that the individual market works very well. It is the largest risk pool in America now with 22, soon to be 23 million lives. And it has had a trend of 3.5% per year over the last 3 years, in large part because the market works for the individual in buying what they need versus having their employer or their HR department or someone in the organization that they work at decide what it is, what their coverage will be. And I think this demand for choice and things that work for me are now the places we need to go. And it's harder for larger organizations that have huge lines of business that are focused the old way to make that pivot. But I think this will accelerate that pivot as we go forward.
Mark, I wonder, on that point, the ACA is the marketplace that Oscar Health plays the most in. And with the changes coming down from the Trump administration, or potential changes, the proposals at least, how concerned are you with some of the things that we've heard, topics like deregulating the industry, cutting aid for subsidies, or premium subsidies, reducing Medicaid eligibility, and even removing pre-existing condition protections that have been part of the drivers of the ACA's popularity? Does that concern you?
Let's start with sort of the things like removing pre-existing conditions. Actually, eliminating pre-existing conditions has not cost the industry virtually anything. So we're not making any headway when you look at the data. I think having more deregulation in the amount of product offered in the ACA is incredibly important, because not everybody wants something dictated to them by the federal government on what plans are available. And there's been a fear that Americans don't have the ability to discern among plans, and we get confused. It's just the opposite. With the broker community, they're actually helping members select the right plans. As it relates to subsidies and Medicaid, let's talk a bit about that. I think Medicaid was originally designed to be at 100% of the federal poverty level. It crept up to 139% because we didn't keep pace with the change in costs. If we move back to 100% and we move those 5.5 million people that are between 100 and 139 into the ACA, they're into a risk pool that A, has more product, B, has better networks in some cases, and also has a more stable cost structure. And so I think the thing we're talking about now is, how do we help people afford their health care? And so far, the ACA has worked. There are some abuses. ACA is not perfect yet in the way people sign up and how they report their income. But those are things that this year are starting to get realigned. And so I would think, particularly given that 63% of the membership in the ACA is now from red states, and we now have red states starting their own state-based exchanges to build a bigger individual market, that I think, A, the ACA is not going away, and B, there will be some form of subsidy to help those moving from Medicaid into the ACA, but also to provide a way to have a tax.
Oh, Mark, I think we are losing
for
you.
members in the ACA.
Oh, got that, Mark. Thank you so much. Really quick final question for you off the back of that. You talked about how the reaction from people is understandable. I wonder, combined with kind of the political moment that we're in and what you talk about, the frustration from people that we've seen play out and who they're voting for, combined with the reaction to what happened to Brian Thompson here, what is the single biggest message that you would want to express to consumers who are frustrated about the state of the insurance industry right now?
Change will happen. We are going to drive that. We believe an individual market for every American, so they can buy what they need and they want in covering their healthcare costs, is the way to go in the future. And we're working toward that opportunity by demonstrating to people with our NPS of 66, which is higher than the industry average of 0, that we can make the customer experience better. And by making the customer experience better, people can have more seamless access to their healthcare. And so I think that change is on the edge. I think we could use some help from the new administration in how we build that product. But I think that's the way we need to go. And I think that's the new version of healthcare for Americans versus the 80-year-old version we're living with now.
Mark Bertolini, thank you so much for joining us this morning. And thank you to our own Anjali Khemlani for bringing us the conversation. We appreciate it.
Thank you.
Coming up, TikTok fighting back after divest or ban law is upheld by judges. More on the app's future in the U.S. when Catalyst comes back.
TikTok's China-based parent company has until January 19th to divest the social media app or face a ban in the U.S. That's unless the Supreme Court or President-elect Trump intervenes. Now, here to discuss what's next, we want to bring in Colin Costello. He's Freshfield's CFIUS and National Security Advisor. Colin, it's great to have you. And when we talk about what is next, I think the big question looming right now is the January 19th deadline. Obviously, that is the day before President-elect Trump takes office. In terms of what investors or maybe what the American public should be considering here, just in terms of the likely next steps, how do you see this progressing up until the 19th and then beyond once the Trump administration is in the White House?
Well, certainly TikTok and ByteDance have already announced that they plan to appeal this to the Supreme Court, and the court could, at least in theory, get this on a docket pretty quickly and review it. The question is really, will they grant a writ of certiorari in the first instance? And there's questions about whether or not they would even have much to review. The Circuit Court here was pretty definitive in terms of its ruling. It didn't leave a great deal of ambiguity. Its ruling that this law passes muster under strict scrutiny, the highest level of scrutiny, when you're talking about a First Amendment case. It ruled that the government has a compelling national security interest and the law is appropriately narrowly tailored, and it's a unanimous decision. So it really, of the things that the Supreme Court could review here, it's pretty limited. It's not going to be a matter of discussion whether or not the correct standard was applied. And of course, the standard of review in these types of cases is something that constitutional lawyers fret over a great deal, and the public, I think, probably doesn't care very much about. But they did apply the highest standard, so it's not going to be a subject of discussion. And TikTok, in their press release, says that the Supreme Court has a long history of upholding the First Amendment. And of course, that's very true. Even in the current composition of the court, this is sort of an area where there is pretty much unanimous agreement among the justices. But I think that TikTok may be overestimating the extent to which that unanimity might play out in a case like this, where the issue is national security.
And this morning, ByteDance and TikTok asked an appeals court to temporarily block that law that would require the divestiture here. I just want to ask the question on consumers' minds. How likely is it that TikTok is not going to be available in the United States come January 20th?
So the question then becomes, what do you mean by not available? Because obviously how the law is going to be implemented is it's going to be implemented through service providers like the App Store, like the Google Play Store, who aren't going to be able to, say, push updates or allow further downloads. So it isn't going to be the case that on the 19th or 20th, rather, everyone who has TikTok, all 130 plus million people, that app is just going to vanish from their phones. It's going to be a matter of what happens when updates need to be pushed, what happens when patches need to be released, and that can no longer be done through the App Store or Google Play Store, for instance, because I think out of an abundance of caution, certainly, no matter what the result is with respect to the Trump administration coming in and perhaps even saying that they're going to avoid or delay enforcement of the law, it would seem prudent on the behalf of companies to probably act as if this law is going to remain in effect and indeed start to enforce the quote ban via removing it from their services.
I want to play Yahoo Finance executive editor Brian Sozzi. He had a chance to sit down with Project Liberty founder Frank McCord. He had recently advanced a bid here to buy the social media site TikTok. Here's what he had to say just about the potential path forward here and his interest within the company.
Let's see if we can find a way here to make this a win-win-win, where the U.S. TikTok is split off from ByteDance. China gets compensated for that. U.S. citizens are no longer have their data scraped and have information, quote unquote, spread to them, which may or may not be accurate. And Americans can be protected, and the U.S. government can fulfill its duty to protect American citizens.
Colin, is that win-win-win scenario, is that likely? Is it realistic?
So it might be necessary. Now, what TikTok has been doing for the better part of several years now, ever since the initial CFIUS order in August of 2020 from President Trump ordering the divestiture, is they have been working with the Biden administration to develop a national security agreement. And this agreement's discussed in the court decision, which is unique because typically these agreements are quite confidential. But what you see is that the what they're trying to do is a construct where they effectively have a separate U.S. entity from an IT perspective. They have a tiered system of data protection, and they have a trusted third party managing the data and reviewing the code. Well, that's going to obviously, to the extent this law magically goes away, and they just continue to exist under ByteDance ownership pursuant to a CFIUS mitigation agreement, is going to basically treat TikTok US separately, but it could also be equally applicable to an eventual sale and spinoff, if indeed that's the direction they're going in. Because notwithstanding the fact that this apparently hasn't been accepted by the Biden administration, CFIUS, they are nonetheless implementing certain aspects of it already proactively. So those things that they are already implementing could lay the groundwork for a future spinoff, which of course ByteDance has already said it has no intention of doing.
And it's interesting because this particular law targets and is focused on TikTok and ByteDance specifically, but you know that this is part of a broader national security concern for foreign involvement here. Can you talk to me about what legislation could look like moving forward that might be a little bit more of a broad approach to data security versus kind of a whack-a-mole approach to individual platforms?
Right. I mean, so what we've seen over the past 5-6 years now is that there are a variety of government authorities that have been used to address this issue of data and availability of data via apps, via the internet to foreign adversaries. And one of the major ones is obviously CFIUS, but we've also seen executive orders promulgated now on protecting American data. And what it looks like from an outsider is sort of trying to catch wind in a sieve, right? Because you're talking about trying to control the flow of data online. And in the absence of a broader framework, sort of like a US GDPR, you're going to ultimately always be in a reactive mode. You're always going to be doing this whack-a-mole approach. But, proponents of that approach might say, that's not a bad thing necessarily. A US GDPR would create a significant regulatory burden for everyone, whereas this particular approach is more narrowly tailored, and it's going to allow us to address the risks where they crop up. So I'm not sure if I see any sort of generalized appetite for a GDPR-style law in the United States, so long as this system that they have implemented and the authorities that they're bringing online appear capable of addressing specific threats.
All right, Colin, we got to leave it there. Thanks so much for joining us this morning.
My pleasure. Thank you.
Coming up, China signaling an increase in stimulus to come next year. We'll discuss what this could mean for the world's second largest economy next, right here on Catalysts.
China is signaling a more aggressive approach to stimulus as the world's second largest economy remains in a sluggish recovery. Now, top leaders saying that they will embrace a, quote, moderately loose monetary policy in 2025. We certainly have seen that reaction play out in the markets early here this morning. But the new wording for this policy, it's the first change that we have seen, or marking the first easing of the stance that we have seen since late 2010. So making it significant there. I think the big question, Maddie, for investors is what exactly moderately loose means ultimately in terms of the longer term, how big of a stimulus, how big of a boost this will be for China's economic growth, and also just whether or not it's going to be enough. What we have heard, some of the developments over the last several weeks, we've had a couple of guests come on and talk to us about the fact that it's too early to tell. There's so much uncertainty. They're not exactly sold on what is being said here or what is being done up until this point. So again, the fact that China is adopting this appropriate loose monetary policy here, I think it also just highlights the situation, the current economic situation that's playing out there right now.
Right, and the potential of China to kind of put forward this idea that they're preparing for a tit for tat with the incoming Trump administration, shoring up their own consumers. China historically, the federal government has been very anti-stimulus for consumers. This is a shift, very historic shift from a plan that has not involved loose monetary policy since you said was implemented back in 2011 here. So a significant shift. The question here, the federal government can introduce stimulus, but the problem we've seen historically in China is that smaller local governments are a little bit more hesitant to put forward that stimulus to use in a way that does see consumer purchasing power moving to the upside. It's also interesting in the context of the news we got this morning on the Nvidia probe from China. If you want to get Donald Trump's attention, hit the biggest stock in the S&P 500. And that is certainly what we saw this morning with Nvidia moving to the downside. Plus, they're shoring up their commercial and consumer spending with this potential stimulus news coming in here. Is this, again, part of a tit for tat? Is it a Band-Aid, or is it something that is more serious to shore up the Chinese consumer?
Yeah, we heard from Xi Jinping just a couple of days ago on the 6th, just talking about the fact that Beijing is continuing to grow. Their growth target here remains unchanged for next year. He called for more forceful fiscal stimulus ahead of this development here, just to mitigate some of the expected tariffs that will likely be announced under Trump. But exactly, yes, the cause of it or why we are seeing this now remains up for debate. But I think it's pretty clear just in terms of the tit for tat and what we have seen play out going back to the first Trump administration.
Absolutely. Well, we're going to stick with China because China is also buying gold again after a 6-month pause as the country looks to boost investment demand. Gold prices rising on the news. Joining us now to discuss this and more, we've got Burns McKinney. He is the Senior Portfolio Manager at NFJ Investment Group. Burns, it's great to speak with you here. Talk to me about what the totality of these moves from China represents. They're buying gold, they're loosening their monetary policy, they're engaging in a little bit of a rebuffing of Nvidia here. What does this tell you about any potential investment opportunities in Beijing?
Well, with respect, first of all, to gold, that's something, we rarely recommend our clients try to make timing bets on gold. Gold, because it's an uncorrelated asset, it offers diversification benefits if you put a small sliver of it into portfolios. Now, going back to the point of China and the fact that they're introducing both now monetary stimulus on top of a fiscal stimulus that's already been announced a few months ago, it is, for one, I think it's positive insofar as it does indicate that the policymakers there see there's a problem. And likewise, a lot of prior generation stimulus that you've seen in China has actually come on the infrastructure side. It's come on the real estate side. Really doing something with respect to consumers would be a positive going forward. I think that there's certainly in the near term there could be a lot of volatility, especially with the tariffs that are being introduced. But for investors with patience and a long-term time horizon, you do have valuation on your side when it comes to China, and you do have as well a lot of headwinds turning to tailwinds as far as the regulatory onslaught on some of the tech companies. As well as the fact that we're now starting to see fiscal and monetary tailwinds also.
Well, Burns, and what should that strategy look like if you're looking to gain exposure to China? By how much? Where are those opportunities within there?
One of the things that we're really looking for, given the fact there is still some concern on the real estate side, is the fact that you have try to find secular tailwinds. And one of the places that you can get that would be a continually rapidly growing middle class. That's something for which you have demographics. Demographics are fairly predictable, and trying to harness the middle class in China, ways of doing that would be within some of the banks. I think that you do see a country that is fairly underbanked, places like athleisure. Or that's actually a great way to get that exposure would be through some of the technology companies in China. You get things, like taking advantage of e-commerce. Things like Alibaba is one that certainly has faced regulatory challenges in recent years, but they're sitting on a ton of cash. You got a name trading at 10 times earnings, which is below Amazon, below the e-commerce peers, and they have other businesses that really, for all intents and purposes, are getting for free.
All right, Burns, thanks so much.
Thank you.
That does it for Catalyst here today, but keep it right here on Yahoo Finance. Wealth dedicated to all of your personal finance needs is coming up next. Brad Smith has you for the next hour. We'll see you tomorrow.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, we'll do a deep dive into your portfolio and talk to an investment strategist about the sectors that you should consider adding potentially. And we'll examine what's to come in the housing market for 2025. Where are mortgage rates heading, and what will a Trump administration mean for the sector? Plus, people aged 73 and up. Hear me out here. You need to take your required minimum distribution before December 31st in order to avoid a penalty from the IRS. We'll explain a little bit more on that later. But first, let's take a look at some of the market action. 90 minutes into the trading day today, stocks edging lower just a bit to start the week as we look ahead to fresh inflation data with November's Consumer Price Index CPI out on Wednesday. Joining me now, we've got Scott Ladner, who is the Horizon Investments Chief Investment Officer. Scott, good to have you on the program here with us today. What are your expectations given the week ahead and some of the consumer-focused data that we're anticipating here?
Hey, Brad, thanks for having me on, first off. And look, we are, still pretty bullish. We think that the CPI data is clearly the big number this week, and it should cement, another Fed cut coming into later on in December. But overall, like all these consumer names that we're seeing and all the earnings reports that we have been getting over the last couple of months are continuing to tell the same story. Like this is a U.S. consumer that's incredibly strong, that is making, that everybody that wants a job has a job. They're getting raises above inflation, and they're spending that money. Not to even mention the sort of the untapped home equity lines of credit and the amount of savings and money market accounts and savings accounts and checking accounts that's absolutely massive and underappreciated. Like overall, like when you have a consumer that is this strong, you just got to invest in because the economy's going to be doing great.
I was taking a look through some of your notes here, and normalization, one of the top words that came up for you as you're assessing the kind of macro backdrop here. And as you're thinking about normalization, what does that mean in terms of the kind of transitive narrative for the equities market and what that really holds for some of the top areas in 2025?
Yeah, I mean, look, normalization to us is something that we've been talking about for a bit. Just briefly, we have not been in a business cycle the last 3 or 4 years. The post-COVID period, essentially, more like a war and a war recovery. And this is the primary reason why the quote unquote leading economic indicators that everybody thought a recession was coming, they frankly just didn't work because leading economic indicators require the kind of the sine wave looking business cycle, and we just haven't been in one. But we do think we're getting back into one now. And so, the important part for investors to understand is that as we come into a more traditional business cycle type of outlook, that means you have to start looking at Fed policy more carefully. You have to start looking at fiscal policy more carefully. Where are we in this quote unquote business cycle? And we actually think we're sort of troughing on slowing growth in the U.S. economy, and actually going to be accelerating again. And as you saw, with Fed and other central banks as a sort of a global backstop to risk assets. And just on the previous guest on the previous show, they were just talking about Chinese stimulus, fiscal stimulus. You got something like that coming. That's going to save Europe and save China possibly. And so then you've got coordinated global growth going on. And again, so this you just probably want to be invested in the more cyclical parts of the economy plus the mega cap tech guys. That's really where the money we think is in 2025.
How much focus do you see the market continuing to have on the Fed? And I ask that because it seems like once they've begun their cutting strategy and the policy pathway in that realm of mind and that frame of mind, it seems like the markets are kind of putting that not necessarily fully on the back burner, but it's not the top of priority. And if it's not that, then where does kind of it rank among some of at least the early 2025 factors that could really reallocate some portfolio positioning from your assessment here?
Yeah, Brad, I think this is a really important question you just asked. And we've been talking about the Fed kind of ad nauseum for like 2 or 3 years now. We shouldn't want to talk about the Fed anymore. I mean, the Fed should be in the background. And that's after this meeting in December. We think the Fed is mostly going to be in the background for 2025. This is a good thing. This means that we get to stop focusing on sort of parsing out the words of different Fed speakers, trying to read tea leaves about did he say this word or that word or whatever, try to figure out Fed policy. The Fed is just going to be in the background. And global central banks overall are going to be in the background in 2025. And this just means that we can focus on the important parts of the economy. Like, is the economy growing or shrinking? Are corporate profits doing better or worse? Is the consumer getting healthier or staying the same? The sort of the traditional things that we can and should usually look at. We think we're going to start looking at that stuff again in 2025, but it hasn't mattered as much until now. But it's going to matter a lot more going forward than it has in the last year or two.
So some of your top sectors heading into 2025, where do you see the most opportunity? And on the other end of that, where are you avoiding?
Yeah, look, you can't we do think this is the mid-90s, and we think that is the right analogy to be using. We've said this for a couple of years now. AI is him, as my kids would say. This is the real deal, and you got to get on board it. And so, that is going to drive a lot over the next 2 or 3 years, we think, in terms of valuations, in terms of market performance, in terms of productivity. So you have to be, you got to be at least market awake in tech. And that is definitely going to be the place to be. Outside of sort of the generic tech stuff, you probably want to start looking at some sectors that are going to be Trump adjacent or at least Trump helpful. Think things like financials, which we have, frankly hated for several years now. But financials could be in a sort of an acquiring space. And, they're going to start doing M&A again because of a more friendly regulatory environment. Also look at things like aerospace and defense. Because frankly, if Trump can bully Europe and other places into spending more money on their defense, that means they're going to buy things from firms like Lockheed Martin and other U.S. Sort of defense suppliers. So those types of sectors we think could actually get a boost. In terms of things that we don't like that much, one of the people think that is Trump adjacent or kind of a Trump friendly trade is energy. Because of the drill baby drill mantra and everything else. But drill baby drill is not helpful for the price of the commodity. It actually puts kind of a lid on the price of the commodity, and that's actually not helpful for the equity securities for inside the energy space. So we really don't like energy very much. The other one we don't like very much is consumer staples. Consumer staples really need one of two things to work. They either need inflation or they need a recession. We got neither. And so it's not that you necessarily lose money in consumer staples, but they're certainly not going to keep up with the market that we think is going to be pretty darn strong through 2025.
Scott, thanks so much for taking the time here with us. Really appreciate it.
Appreciate it, Brad.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's go to Warner Brothers Discovery, reaching a multi-year renewal deal with Comcast to provide its content with networks like TNT, the Food Network, and CNN to Comcast subscribers. The agreement also expands Comcast's rights to package ad-supported versions of Max and Discovery Plus in its streaming bundles. The deal comes amid growing challenges in the sector as consumers continue to cut their cable packages in favor of streaming services. Next up, SoFi has been cut to outperform from neutral by Bank of America. This is a valuation call. The analyst arguing the post-election Trump-fueled rally has pushed the stock price too high compared to company performance. However, the analyst does see upside from potentially less loan forgiveness policies under a Trump administration. Finally, PayPal getting an upgrade at Bank of America to buy from neutral. The analyst citing demonstrated turnaround progress, and the company sees potential for acceleration in transaction profit growth next year. Bank of America lifting its price target to $103 from $86. Well, Workday and Apollo Global Management, Yahoo Finance's parent company, will join the S&P 500 index before the market open on Monday, December 23rd. And AppLovin, an AI play that is up more than 700% this year, was not chosen to be in the index. So how does that happen, and what goes into picking a stock for the S&P 500? Yahoo Finance's Jared Blickry has the details for us. Hey, Jared.
Thank you, Brad. While it's tempting to think of the S&P 500 as this monolithic collection of giant stocks, its composition actually changes a few times a year. And the world's largest stock index has two smaller cousins. You have the S&P 400 that follows the mid caps, and the S&P 600, which houses small caps. Exactly who gets added to these three indices, it's decided by a committee over at S&P Dow Jones Indices. Oftentimes, they're just moving stocks from one of the indices to the other as they get bigger or smaller in price and value. Now, the committee just announced that on December 23rd, Qorvo and Amentum Holdings, currently in the S&P 500, they're going to get bumped down to the S&P 600, which holds those small caps. In their place, Workday and Apollo Global Management, again the parent company of Yahoo, are getting added to the S&P 500. It's a big deal, and among the requirements are a market cap or value of $18 billion or more, and the company has to have been profitable for the last 4 quarters. Inclusion, it's not automatic. However, the committee has wide latitude to consider other factors that might be in the best interest of the investors and the indices. So Tesla is a good example. You might remember that the EV stock was added to the S&P 500 way back in December 2020, and it seemed to take a long time for Elon fans. But the committee finally wanted to see consistent profits, and then it was added. And when it was finally announced, Tesla, it got a big pop. It was up 20% over the next 2 days and up 70% over the following month into the day when it was officially added. Now, Tesla is up an additional 70% since then, having hit $400 per share share, which is the highest price since January of 2022. And let's go to the Wi-Fi Interactive, and I'm going to chart this real quickly. We're going to see 1,021 days have elapsed since Tesla was first announced that it was going to join the S&P. Then when it did, there was a tiny little dip. You can't even see it here on this chart. Then it raced up here, and this is the 70% gain that I was talking about. And then we got a little bit of a pullback, and then we got the race to all-time highs, which we are now challenging. And I thought we'd do a little technical analysis on Apollo Global Management, and you can see, and let's just do a year-to-date chart here, you can see it's up almost 90%, having done most of that climb since the middle of the year. And we can also take a look at Workday, which is not performing quite as well this year. Let's see if we can get a one-year chart. Well, not participating, but it's up a few percentage points this year, and really what the committee was looking for was that consistent profitability. So we'll have to see what happens come December 23rd, but we will see a little bit of a difference in the change in composition of the S&P 500.
Yeah, it looks like year to date, the stock up by about 5% for Workday here. Just taking a quick look at a chart I could load up here in the absence of participation there on your screen, Jared. Thanks so much, appreciate it. Coming up, everyone, how to approach Bitcoin after it hit the $100,000 milestone. That's next on Wealth.
From creating graphics cards for gaming to becoming one of the world's leading AI chip companies, it's safe to say Nvidia is officially one of the tech giants. In 2023, the company generated nearly $27 billion in revenue, and its market cap is currently hovering at around $3 trillion. Let's take a closer look at what led to Nvidia's boom with Beyond the Ticker, where we dive into the company's biggest moments. Nvidia was founded on April 5, 1993 by Jensen Huang, Chris Malachowski, and Curtis Priam, with a vision to bring 3D graphics to the gaming industry. In 1997, Nvidia launched its first hit product, the NV3. It would later go on to sell a whopping 1 million units in its first 4 months of availability. On January 22, 1999, Nvidia went public via IPO at $12 per share. And in 2000, Microsoft chose Nvidia to develop the graphics hardware for the first Xbox console. 5 years later, Microsoft's rival Sony chose Nvidia's hardware to power the PlayStation 3. In 2010, Nvidia became the graphics chip supplier for automaker Audi. And in 2015, the company launched its Nvidia Drive chip for powering driver assistance technologies. In 2016, Nvidia kicked off its AI efforts with the launch of the DGX-1. 2 years later, the company debuted Nvidia RTX, the first GPU capable of real-time ray tracing. That same year, Google announced it was using Nvidia's Tesla P4 graphics cards for its Google Cloud platform. In 2022, Nvidia debuted its H100 graphics chip for AI, which still stands as one of the world's most powerful chips for artificial intelligence apps. On June 5th, 2024, Nvidia eclipsed that $3 trillion mark, joining the ranks of mega companies Apple and Microsoft. The stock continues to surpass its all-time highs over the past month and is currently trading well over $1,000 per share. From a company of 3 engineers working on graphics cards to thousands of employees working on chips that will power the AI supercomputers of the future, Nvidia remains at the top of the tech industry.
President-elect Donald Trump's crypto team officially taking shape. Yahoo Finance's Josh Lipton is here now with a closer look at what it means for investors. Josh, what's your assessment thus far?
All right, Brad, well, let's get to it. President-elect Donald Trump made it clear when he was on the campaign trail he was going to be an ally of crypto, and that pledge and, of course, his victory helped spark a surge in Bitcoin, which stormed above $100,000 as Trump made a series of promises to the crypto crowd, like appointing a crypto presidential advisory council comprised of people who, he said, love your industry, not hate your industry. So who's going to help spearhead Trump's efforts in this red-hot crypto space? Well, the team is now coming together. Trump tapped Silicon Valley investor David Sachs to be the White House crypto and AI czar. Sachs is a well-known investor in Silicon Valley with deep roots in our nation's tech capital. He is a member of the so-called PayPal mafia, early executives of that payments firm that included heavyweights like Elon Musk and Peter Thiel. So what does Sachs have planned for his new role? Well, remember, over the summer on X, he posted what the crypto industry has been asking for more than anything else is a clear legal framework to operate under. If Trump wins, the industry will get this, and more innovation will happen in the U.S. Now, another big name that crypto investors need to get to know is Paul Atkins. He is Trump's pick to run the SEC. As our colleague David Hollerith reports, Atkins is the boss the crypto industry wanted. He is a veteran financial regulator, having previously served as Republican SEC commissioner who favors clear regulations of cryptocurrencies that don't stifle innovation or impose unnecessary oversight. Now, I recently spoke with Anthony Scaramucci, a well-known Bitcoin bull, but also an outspoken critic of Trump. Still, he tells Yahoo Finance that he supports Trump's decision to have Atkins at the helm of the SEC.
I know Paul a long time. He's a libertarian by nature. He's a terrific person. Believe it or not, he's liked on the left and the right. So, of course, there are Gensler enthusiasts that hate Bitcoin. My former high school friend John Stark is one of those. He likes Paul Atkins. And so you've got pro-Bitcoiners and anti-Bitcoiners that like him. I think he's a very fair guy. And I think he'll do an amazing job for the president and for the country.
And remember, it's not just Sachs and Atkins, of course. Other well-known crypto fans include Howard Lutnick, that's Trump's choice for Commerce Secretary. You've got Robert F. Kennedy Jr., his nominee to lead HHS. And of course, J.D. Vance, our crypto-owning vice president-elect, Brad.
All right, excellent breakdown. Tracking all of the names moving around within the crypto
A lot of big names in there.
Yeah.
Yep.
All right, Josh, appreciate it. Data from financial firm Luthold Group shows that riskier assets like Bitcoin, meme stocks, and gold have outperformed a conservative portfolio of 60% stocks and 40% bonds in 2024. For more on the path forward for Bitcoin, I want to bring in Matt Kors, host of the Matt Kors Show. Matt, good to have you back on the program with us. Let's just start there. What is your anticipated path forward for Bitcoin now that we've notched and hit this milestone of 100,000? And now there's a larger question of, all right, well, how much further can we run and in what amount of time, most notably?
Always happy to be here. Thanks for having me on. I think a lot of this has to be looked at in one of two ways. In my humble opinion, what we have with Bitcoin, it's one of two things. It's either the best store of value ever created, or we're looking at another tulip mania that is maybe on the precipice of popping. I don't think the bubble is going to go that way. This is my own opinion. I think there's no middle ground. I don't think we're going to stop here. I think either going to zero or we keep climbing higher and higher and higher. Now, in the short term, your guess is as good as mine. We might as well just be flipping a coin. But in the long term, if this idea of a store of value and the US dollar always being devalued, I think Bitcoin goes higher and higher. So yes, I know that there's a lot of people making money on actively trading it, but I'm a much bigger fan of simply dollar cost averaging.
And so with that in mind, how would you be dollar cost averaging even on some of the milestones hit and then even on the pullbacks as well? Because even in that dollar cost averaging, it relies on you selling a little bit of your overall stake or your portfolio that you may have built up in order to then take some profits, buy back in at a lower level, assuming that there's going to be and hoping that there might be a pullback as well at some point.
So with that, I think there's two schools of thought. I think the easiest option is literally a day per month that you just pick and buy a small portion and just keep doing it. personally, for me, for people who want to feel like their fingers are a little bit more on the pulse, I wait for a certain percentage pullback from whatever the recent high is. But there's various models that show either of these historically, they're actually pretty close in terms of today performance. So I don't think that there's going to be much loss if you do any generic form of dollar cost averaging.
Certainly. What's the next major milestone or catalyst that you think that the crypto community needs to see in order for 100,000 not just to be justified, but for it to feel like we can move even higher from this point?
In terms of justification, I think that's almost the values in the eye of the beholder as we see inflation rip and the value of the dollar going down and down and down. I think we kind of get this backwards. I think people are viewing Bitcoin as it going up from the bottom left to the top right, when in reality, to me, Bitcoin is holding constant. It's actually the US dollar going from the top left down to the bottom right. I think the way we actually view the Bitcoin chart is incorrect. I am always betting on the US dollar going down, and it just seems mathematically, it's the mathematical sleight of hand that on a relative basis, Bitcoin's going up against it. So in terms of value, that's how I see it. In terms of next major catalyst, as the previous segment was talking about, yes, we're going to get a new chairman of the SEC, so that's going to bring new regulation. I think this is actually going to be a very positive time. In terms of value, I think there's going to be excitement at 2 and 2.5 trillion for overall Bitcoin market cap. But from there, I think the next big psychological level in terms of US dollar value will be 250,000, which I want to make clear, I do believe is very possible in the upcoming calendar year.
All right. One of the original meme stocks as well, GameStop, reporting earnings this week. Want to get your thoughts going into that print.
These times are always exciting because it's high risk, high reward. If you're on the right side of it, you can make money. Unfortunately, I've lived through this for the past 3 to 4 years, where it seems like a lot of people are maybe a little bit more too much in the hype side of it and not really respecting the risk. I'm not against hype. I think that community itself can add a lot of value. It does to a lot of stocks and cryptos and other things that we all commonly talk about. But I think it's one of those things where sometimes the excitement and that almost tribal group, it makes people where you don't respect the risk at all. If you look at the last 5 earnings from GME, a lot of the times it's just the premium sellers that end up winning because the move isn't that great, and then there's just a lot of IV crush. So for this particular earnings, I would say it's a crapshoot. To me, it's binary. We're flipping a coin, and hey, if you want to play it, I hope you're on the right side of it. But to me, the money's going to be made in investing. And when I look at the entire total investable universe, GameStop's not really a top tier one because we don't have much forward direction from the company and the company's leadership at this moment in time.
I wonder what you make of at least the social chatter that seems like it's shifted from names like a GameStop to names more like a Palantir, names more like a Tesla, and how that ultimately you anticipate see playing out even further from here if you do see some of the investors that were in some of the momentum trades or the meme trades before start to get a little bit more interested in names that they can see a material move in tied to some type of actual fundamental activity that's taking place.
This is such a phenomenal question. I absolutely love it. My approach to the market, my mental framework is it's better when the long-term direction in your thesis is also in alignment with maybe potentially your short-term trend. So right here, what we saw the craziness of GameStop and AMC, that was an active trend going to the upside that anyone who understands fundamental analysis would never say that was a fair fundamental value. But once in a while, as you alluded to with Palantir, with Tesla, you get this very excited group that's supporting it. But yet, when you look at the fundamentals of the company, they're also great. Palantir, if you look at its year-over-year, quarter-over-quarter growth, phenomenal. Tesla, right now, the FSD 13, the quality is great. The Cybercat. So to me, this is kind of that perfect storm of you get that retail personal excitement, but it's also backed by strong fundamentals. I think it's the best of both worlds.
Matt, thanks so much for taking the time here with us today. Good to see you.
Thank you.
It's been a challenging year for the housing market with high mortgage rates, steep prices that continue to go up, and low inventory. There's been a lot of pressure on both buyers and sellers. So what could a new year and a new president bring for the housing market? Here with her outlook, we've got Danielle Hale, who is the Realtor.com chief economist. Thanks so much for joining us here. So let's just start there. What does a new person sitting at the Resolute desk at 1600 Pennsylvania Avenue mean for the housing market?
I think that's a great question. Thanks for having me, Brad. So we know we've not just got a new person at the desk at 1600 Pennsylvania Avenue. We've also got a new Congress, and both the Senate and the House are likely to be of the same party. So I think the administration and Congress have a pretty clear mandate from voters to get something done. And we do know that housing was a talking point on the campaign, that the Trump campaign recognized very much that we don't have enough houses. Housing, as a result, is too expensive. And so we need to bolster supply in order to help improve affordability in the housing market. He's got some proposals for how to do that. I think what will ultimately matter is how those proposals become policy. And for that, we're still playing the waiting game as we move into 2025.
You know, it's interesting in what we had heard on the campaign trails and bringing mortgage rates back down to 3%. It seems like that is unlikely to happen. But what is perhaps the most likely outcome of where we could see housing affordability moving towards once we do get a new Congress and then additionally a new President-elect Trump taking the office?
Yeah, so I don't think we're going to see mortgage rates move all the way back down to where they were over the last few years. Our expectation is that we'll see mortgage rates edge down to 6.2% by the end of 2025, and that'll mean an average mortgage rate of 6.3% across the year, because we expect home prices to continue to climb, but not as quickly as we saw in 2024. That means that those falling mortgage rates will basically help offset that gain in home prices, and monthly payments will be relatively flat. If we combine that with a healthy economic backdrop, which we expect, it means incomes go up, and we should see affordability improve very modestly for home shoppers in 2025.
And what about for people who are just waiting for the right time to actually list their homes? Are we anticipating a major shift in at least the mentality around what the timing is for listing their homes and what they would need to see in the propensity for buyers who are ready to come off the sidelines?
I still expect spring to be the peak season, but I do think as mortgage rates come down throughout the course of 2025, then we're likely to see some improved conditions in the second half of the year. But again, spring and summer is still going to be that peak home buying and selling season. Sellers are in some ways impacted by mortgage rates just like buyers, because many sellers have a low existing mortgage rate that kind of has kept them locked in place. As mortgage rates come down, that will help ease some of the pull of that lock-in effect, but that's going to be a really slow process. So it's going to be life events that drive selling decisions. People who've maybe put off selling, even though their home situation has changed, might be able to move forward in 2025. We expect to see inventory climb by 11.7%. That's not going to get us all the way back to pre-pandemic levels of inventory, but it is going to continue to chip away at that. And we're going to see likely the highest levels of inventory that we've seen since 2020 in the year ahead.
I see within your forecast, you're also expecting home prices to continue to rise in 2025, slightly lower pace here of 3.7%. And I wonder, how much does regionality also play into that? People who are looking across affordability in regions, people who are looking across even weather and where they would be moving to in order to potentially offset what they've had in the back of their minds as a major deterrent for why they would purchase in one area or another.
Yeah, that's a really interesting question. So we've got kind of different factors pushing things along there. So in the South, we've seen inventory recover better, and so we expect to see somewhat weaker price performance in some markets in the South. Other markets in the South are going to see stronger price performance, where we've seen a lot of new construction go up, and so a shift of the share of homes that are selling that are existing versus new. So the South is going to be a big mixed bag. I'm talking about the South as well because you asked about weather risks, and we do know that the South has some substantial climate risk, especially the Southeast, along areas that are impacted by hurricanes. That information is available to home shoppers on sites like Realtor.com. So anyone who is considering those risks or making a home purchase in an area that maybe they're not familiar with should be sure to check out that information and make sure that they are informed about the risks and find out a little bit what that means. It can make it harder in some cases to get home insurance. You'll also want to consider getting flood insurance alongside your regular homeowner's insurance. So especially if you're moving to a different area that has different risks, it's worth exploring those. It's not just flood, but also wind and fire and heat and air quality risk information that is available on Realtor.com and many other real estate websites. So it's never been easier to get informed, and I highly recommend that consumers do that.
Absolutely. Danielle, just one more while we have you here. As we think about the effective household tax rate, What are the biggest changes that home buyers and homeowners should be anticipating going into next year, given what we've heard, long campaign trails going into the election, and now once we finally do see some, of course, anticipated movement within Washington, D.C.?
Well, I had hoped it was going to move earlier in the year. It sounds like now tax changes are going to happen later in 2025, which means they'll probably take effect in 2026 and not before then. But I do expect rates to at least stay the same and maybe improve for some brackets. I think there's been talk about the state and local tax deduction that could be impactful for certain pockets of the housing market, particularly in high-cost areas. So it would be nice if that got done sooner, but I think we're going to have to wait a little bit longer to see some changes there.
Danielle, thanks so much for taking the time with us today. Appreciate it.
Absolutely.
Coming up, everyone, we've got your Yahoo Finance market update. We'll check out how stocks are moving and run through 3 stories that you don't want to miss. Stay tuned.
We're 2 hours into the trading day and it's time for Yahoo Finance's Market Minute. Stocks pulling back with key inflation and mortgage data on deck this week, though off the session lows at the moment. But here are 3 market headlines to watch. AMD shares falling as Bank of America downgraded the semiconductor firm from buy to neutral and cut the price target from $180 to $155 in a fiercely competitive chip space. They cited lower estimates for AI and PC-related revenue next year. Plus, Alibaba Group trading higher today, along with other Chinese stocks, buoyed by China's leaders pledging to prioritize more proactive fiscal policy and looser monetary policy to boost domestic consumption. And watching Hershey stock jumping to its highest intraday price since mid-September, that's on a report that Mondelez International, one of the world's largest snacks companies, is exploring a takeover. And that's your Yahoo Finance Market Minute to keep you on track with the news you need to make smart decisions about your investments. For more on what's trending on Yahoo Finance, scan the QR code below. More wealth when we return.
If you're in the market for a new credit card, it can be difficult to determine what card to apply for, especially when getting rejected can mean a hit to your credit score. New data from Experian found that a majority of shoppers prefer to use a credit card to buy their holiday purchases. A quarter are selective about the benefits when choosing what card to shop with, while 15% are planning to open a new card this year specifically for those purchases. According to the Federal Reserve, Americans' credit card balances rose by $24 billion in the third quarter, making for a total outstanding balance of $1.2 trillion. And after Cyber Monday saw the highest level of e-commerce spending in history, topping $13 billion, it's pretty safe to say that at least some of those purchases were put on credit. If you're not sure where to begin searching for a new card, Experian, they rolled out a new tool, the No Ding Decline, that allows consumers to see what cards match their current level of income, spending, and household debt. There's 3 steps. Log in or create an account. You can compare your matches using that Experian tool and then submit your applications. And here's the best part, potentially. Any cards marked as No Ding Decline will not negatively impact your FICO score if you're rejected. Now, Experian says that almost 70% of users should have at least one No Ding Decline offer. If you're age 73 or older, listen up here. A deadline is fast approaching for you to take what's called your required minimum distribution, or RMD. Here to explain it, we've got Rita Asaf, who is the Fidelity Investments Vice President of Retirement Products. Rita, great to have you here with us. Start off simple, perhaps, with us. What is your RMD?
Sure. Thank you for having me. So when you reach age 73, you are required to withdraw a certain amount from your retirement plans, generally pre-tax or tax-deferred balances, such as IRAs or 401ks. And this is called a required minimum distribution, or you might see it abbreviated to RMD. And at a basic level, the IRS is now requiring you to take from these accounts with a deadline of December 31st each year, unless you're a first-time RMDer, meaning you're turning 73, you can actually delay that first-time RMD until April of the following year. And so the requirement itself may seem more than you would expect. And actually, Fidelity has found that almost 48% of our RMD eligible clients have not taken any RMD as of right now into satisfying it before that 12/31 deadline. And that's a little troubling because you may face a penalty, which is equal to 25% of the amount not taken.
Wow. Okay, so how does someone calculate their RMD for 2024?
Well, what you normally do is take the balance of what your account was on December 31st, and then divide it by what we call life expectancy factor, which is set by the IRS. And I know that's a complex term, but this corresponds with what your age and what is known as the IRS uniform table. So if we just use an example, let's say you have an IRA account balance of $100,000 as of December 31st, and this is of the prior year. To calculate your RMD, you would use a life expectancy factor of 26.5 if you're 73. So if you just take 100,000 divided by 26.5, it's about 37.73, so $33,773. But here's the good news. Almost every provider provides your RMD amount, so there's nothing to worry about you actually calculating. It is provided for you. And we do see clients taking advantage of what we call automatic withdrawals to help them avoid missing that deadline.
So what happens if you forget to take your RMD? Are there any backstops to that IRS penalty that you just mentioned?
There are. If you take the RMD in what is referred to as timely by the IRS, which is generally reported as within 2 years of when you miss that RMD, you can actually bring down that penalty from 25% to 10%. But you really want to try to avoid missing that penalty just because it's another tax implication for you. And it's best if you can just to set up those automatic reminders or automatic withdrawals so that you no longer have to worry about it.
So what are reasons that people give for not taking their RMD?
A lot of the times they forget. And one of the complexities that actually comes up is the fact that they have retirement accounts of multiple providers. So they may not realize that they have to take RMDs from different accounts with multiple providers, and that adds to the confusion. And that's where it's important where you have this retirement income plan where you know where your accounts are and know where you need to take the withdrawals so that you can best support what your withdrawal strategy is.
You know, with all this in mind, what is the taxation that is typical for RMDs? How are they taxed?
So they're generally taxed as income or ordinary income in the year that they're taken. If you, for some reason, have after-tax money, including non-deductible contributions, which is usually in a traditional IRA, you will have to calculate your RMD based on that total balance, but your taxable income may be reduced proportionally for the after-tax amount. So it is ordinary income, although we find that people pay it differently, whether they do it right at the moment of the transaction or they do it as one lump sum, taking for all their RMDs at a later time of the year.
And lastly, while we have you, what should retirees ultimately do with their RMD?
Well, some people do live off of it, and that is another way to supplement their retirement income. But we do have other ways that we think through to help clients, which is you can invest it. So if you don't need it for your day-to-day living expenses, this is where you can transfer it to a non-retirement account and reinvest it, or even gift for future generations. Thinking of just like a 529 for grandchildren. Second, you could spend it. So that's just one option. Use it for travel, use it for fun. And then lastly, you can gift it. So one way to avoid the taxation on an RMD is to do what we call a qualified charitable distribution. So that'll help you lower your taxable income. And this is a good way to give back to your favorite charity.
Very nice. All right, Rita Asaf, thanks so much for taking the time and the breakdown on all things RMDs. Appreciate it.
Thank you for having me.
Certainly. Let's get a quick check of the markets here as we've seen some stocks pulling back from record highs, and we're checking in on the major averages. They say check in on your friends, and we're doing just that. The Dow Jones, that's down by about 0.1% as of right now, just below that 45,000 marker, ultimately down here on the day by about 53 points. 0.1% is what that equates to. The Nasdaq Composite, you're seeing that right now lower by about 0.5%, and the S&P 500 down by about 0.4% right now. We're going to get some big economic data coming ahead of the Fed's final meeting, the FOMC final meeting for 2024. December 17th through 18th is when that is taking place, but ahead of that, we're actually going to get some key data in the form of CPI, and that perhaps will inform some of the conversation that is set to take place. With that in mind, I'm just going to take a brief look at some of the retail stocks going into that. And as we're taking a look at retail here on the day, you've got some of the major e-commerce and just commerce as a whole players moving lower, at least for Walmart down right now by about 1.8%. Amazon is still holding on to some gains right now to the tune of about 0.75%. It had touched negative territory earlier in trading, so we'll see exactly where that moves as we move on throughout the rest of today's trading session. Costco, another name that's going to be reporting earnings this week. You're seeing that down by about 1% here, so we're going to be keeping tabs there as well. And just more broadly on a sector basis, as we're taking a look and as we were running through some of those major names here that you're seeing within that retail landscape, I'm just going to take a quick look at the sector activity here, as long as the board will cooperate, and since it won't, perhaps we'll leave things right there. And there we are. So sectors, 11 sectors on the S&P 500 loaded up here on the screen. And just quickly, let's take a look at some of the consumer discretionary names. That's down 0.3% on the day. And consumer staples, flat just barely to the downside as of right now. So we'll be continuing to track some of that movement. Of course, we haven't even hit lunchtime here in New York just yet. A lot of trading activity left. Coming up, if you, like most Americans, are looking to progress in your career, stay tuned. We have tips from an expert next on Wealth. A programming note on this week's episode of Financial Freestyle with Ross Mack. Jason So, the CEO of Lock Talk, discusses using a key financial strategy to unlock sports betting success. Take a listen.
So I think for starting off sports betting, it's to your point, how much are you able to lose without it affecting your life? Yeah. Paying bills, paying for food, having fun. Like, this should be money. Look, I love money, right? I don't want to lose anything, but you have to have an amount where if you lost it all, you're totally fine. Your life's not affected. So I think that range could be from anywhere from 1% to 5% of your total net worth. Perfect. So I say, let's say you have $100,000 net worth, which not everyone has, but I'm just using it for round numbers. 1 to 5% is anywhere from $1,000 to $5,000. Then from that amount, that's a amount that you want to bet on for a longer period of time. So let's call it 3 months, 6 months, or 12 months. It's a long-term view because when you're sports betting, you want, like, one day is not going to change your life. You want to do it over time if you have the proper systems and things like that.
New episodes of Financial Freestyle air Mondays at 12 p.m. Eastern Time, and you can catch them on Yahoo Finance or wherever you get your podcasts. If making progress in your career is on your 2025 to-do list, listen up here. Our next guest has some tips for mapping out your priorities on the job hunt. I'm joined by Michael Horn, author of Job Moves, 9 Steps for Making Progress in Your Career. Great to have you here with us, Michael. So first, as you're thinking about even beginning to start the process of making the search and how to make that next job move, where should you begin in that effort?
I think far too many people, Brad, start to think, oh, I'm just going to fresh up the resume, start to blitz it out to every single job posting. And what we advise is actually take a beat, slow down a little bit, and really reflect on what's the progress you're trying to make in your career right now. What really drives your energy? What capabilities do you want to be known for? And after you've done a little bit reflection, then you're ready to actually say, okay, I know how I want to hire my next job. Because people don't think about it. You get to hire your next job just as much as employers are hiring you.
Certainly. So once you start the interview process, how does that mindset really get taken to a new level?
Yeah, I think the big thing is know how to tell your story. We don't actually focus that much nearly enough on what's my elevator pitch? Why is my career shaped the way it has? My resume, it's sort of generic. It's not telling you, the employer, anything special about you. How do I really tell my story? And we actually, in the book, recommend that people adopt the Pixar story spine method so that you can really succinctly nail where you've been, what you've learned about yourself, where you're going, and why this is the job that's going to help them make progress and you make progress.
Which Pixar movie does that the best, Michael? This might seem like a tangent, but I think it might really help for a lot of people's viewing over the holidays so they could watch a Pixar movie and perhaps figure out, all right, I need to model my job hunt and the positioning for myself like that.
I think you got to go classic on this one. Any of the Toy Stories do it brilliantly. And that's really where they honed the craft, right? Of really nailing, how do we tell the story? What's that once upon a time? How do we get you invested in that beginning? Really think about the plot and what the characters learn about themselves. And then, of course, a brilliant resolution on all of those that made us excited for the sequels as well.
All right, Toy Story as the blueprint for the elevator pitch for your own career as well. Michael, one thing that we've also got to think about too is how people typically annex making a positive career move and an upward career move with how much their earnings might also increase as well. How can you be a strong negotiator and advocate for yourself to make sure that you're earning what you would like to as you're making job moves?
Yeah, it's a great question. And I think the big thing is know what the trade-offs you're willing to make ahead of time when you get into that conversation. A lot of people we found in our research, and we studied over 1,000 job switchers, they didn't know what trade-offs they were willing to make to get the progress that they really wanted. And so that's a question of priorities, right? What are the energy drivers? What's the money? What's the benefits? What are the capabilities that you really want to have in that next job? What are the things that you're saying, hey, those are nice to haves, but I'm willing to give them up so that I can get these things that are most important? And if you don't have a sense of how you're going to trade these off against each other, a lot of people get frozen in progress, or to your point, they take a job that's actually not really getting them that progress that they really need as they move.
You know, Michael, I wonder, as I was reading a LinkedIn post from a guest that we've had on before and had some great insights just around how Gen Z and Gen Alpha is really kind of reshaping the way that careers are thought about and the employee-employer relationship, how do you see the future of job moves and career trajectory perhaps not being, cast aside in its historical realm, but at least revamped to really understand the future of labor force participation and the people that are prioritizing some things in work-life balances versus that career trajectory?
I'm so glad you asked this question, because this is one of the biggest things that comes out in the research, which is that employers are really playing from a playbook that's at least a quarter century old at this point, which really frames progress as equating to progression up a career ladder. And what you find from individuals is that at least 75% of them are switching jobs not because they're trying to take that next step, up the career ladder in their job, but instead they're looking to do things like regain control, regain alignment, or frankly, get out of a dead-end job that just isn't working for them. And so that's why I think on the employee side, it's so important to have clarity about what progress means for you, because otherwise the advice you're getting is probably not going to be a great fit for you. But on the other side of it, to your point about how this changes going forward, we think that employers have to have much better systems in place to understand why you chose them when you signed on the dotted line to show up to work there. Or how do we start to craft your job that lets you lean into the things that make you great, and then find someone else to do the things that you're weak at, but you're honest about that up front.
Yeah.
Just much more of a conversation.
Michael, thanks so much for taking the time here with us today. Really appreciate it.
Thank you, Brad.
Everyone, let's do a quick check of the markets here as we were taking a look at the major averages, still in negative territory as of right now. We'll see if that flips as we get towards the end of today's trading session. That's it for Wealth. I'm Brad Smith. Thank you so much for watching. You could stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern Time. They'll count you down to and through the market close.